Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. That's Brian Sazi. We are in for Shauna Smith and Brad Smith today. Let's get to the three things that you need to know today. First up, U.S. stock futures in positive territory on the last trading session of November. The S&P 500 on track for its best month since February following the presidential election. And as investors cheer one of the best years for the benchmark index in its history, with gains above 20%. Meanwhile, the so-called Trump trade is beginning to unwind, with the dollar on pace for its biggest weekly loss in 3 months. Plus, Bitcoin ETFs seeing record inflows this month as the digital token inches closer to $100,000. So far in November, Bitcoin exchange-traded funds have pulled in more than $6 billion, according to data from Bloomberg. That marks the most inflows on record for the ETFs since they launched at the beginning of the year.
Good stats. All right, and the official start of the holiday shopping season begins. Black Friday is underway in America, with shoppers searching for deals in the shortened holiday shopping window. Investors will closely watch for data tracking spending from the consumer to assess the retail space and the overall health of the U.S. consumer. Early data from Adobe Analytics show consumers spent a record $6.1 billion online on Thanksgiving alone. Theme of the morning, holiday markets mania. It may be a day of shopping, but here at Yahoo Finance, we are drilling into some of the biggest investing themes of the week. First up, it's Black Friday in America. Who is winning the battle for shopper dollars, and have investors positioned correctly? Then the tech sell-off spreads. Why is this happening, and should investors be worried? And the long arm of tariffs. Are investors still not getting the risk to their portfolios from the Trump, a.k.a. the tariff man, Julie?
Yes, so as he has dubbed himself. Also, speaking of Trump, we're beginning to see a bit of an unwind of the so-called Trump trade as the dollar, for example, heads for its worst week in 3 months. I don't know if it's an unwind of the trade or if it's just a little bit of a pause of the trade, right? Like it was probably not going to be moving all in a straight line.
Yeah.
And
it doesn't?
A lot of us are sort of having like flashbacks to 2016 and the tweet-driven market. And now it's the true social-driven market. You're already dropping your pen.
There's just a lot going on today. Well, that's a point. I think there's a lot of information coming at investors right now. And they, after the election, you had this burst of enthusiasm, lower taxes, corporate profits are going to double next year, and it's great times. But I think investors have learned the past week, tariffs have ramifications. They could really drill down on profits for apparel retailers, for automakers, and they could have real impacts next year. Nobody thought about this in the days after the election, but they're thinking about it now.
Everybody was thought about it.
They thought about it, but they weren't plugging it into their models and saying, wow, I'm General Motors. I can have 30% of my profits wiped off next year. And the market has to adjust to this stuff.
Yeah. So let's talk about the dollar, for example, here. So it's poised for its biggest weekly loss in 3 months. It had been up for about 8 straight weeks and ahead of this. And the positioning had gotten stretched by some measures here on the U.S. dollar, as many of the incoming administration's policies were seen as maybe buoying the case for a stronger dollar, but we've seen that little bit of a pause or pullback. I talked to Jens Nordvig of Exante Data about the dollar, and this is what he told us.
We have a situation where we've had pretty dramatic ups and downs in the dollar since September. We were weakening dramatically into the Fed rate cut in September, right? And now we've had a strengthening period, maybe up until today. So what's happening with the U.S. yield curve, what's happening with the dollar, really sets the tone for international risk assets.
International risk assets, and also, of course, there are implications, again, as we bring it back to this whole U.S. multinational conversation. If the dollar is strengthening, that also has implications for companies that do business around the world.
Yeah, it also could be, maybe you're getting some signs here, Julie, that, as these tariffs and these various policies come into effect, maybe there's a sharp growth slowdown in the first half of next year.
Maybe, although, this administration is seen as broadly pro-growth, but the question is all in the timing, right? When do those growth policies sort of take effect and hit the market and hit the economy? Another trade we're tracking is Bitcoin, of course. Flows into Bitcoin ETFs in particular, which have been big. We're seeing Bitcoin push back higher here, getting closer to 100,000 once again. But if you look at the inflows that we have seen into Bitcoin funds, ETFs, we have seen a huge amount, including inflows into IBIT, which is the largest ETF, that one from BlackRock. Fidelity has an offering too. $6.2 billion is how much they've taken in so far in November. That's according to Bloomberg. $6 billion was February. That's the previous peak that you see. As, again, this is part of the Trump trade that we have seen. And this part, I don't know if it's unwound, really. I mean, it got within a whisper of 100,000 and then pulled back a little bit, but now it's going higher again.
I was hoping it was going to break through that level on Thanksgiving. I was watching, I'm like, come on, just get through there. Give me something to talk about on Friday morning. But I just, it's not a call on any particular asset. I just feel as though this is just getting started. You know, I had a really cool conversation with Mark Palmer on the Opening Bid podcast. And he was really laying out the case for even more moves higher in Bitcoin. I think his call is like 225 by 2026, 225,000. But it's just the institutional involvement. We've heard about this for the past 4 or 5 years. Institutions getting in. But BlackRock's now involved. Mark was telling me how endowments are now starting to dabble in crypto. These are folks with large, really billions of dollars to get put to work. And they're likely, or they're looking to put it to work finally in crypto. Like everything we've talked about the past few years seems to now be coming to fruition.
Well, and when you talk about the actual policies as well, so there's the institutional involvement, which has been the case all this year, and then there is now the Trump trade aspect of this. So who's going to be the next head of the Securities and Exchange Commission? We still don't know that, but it's expected it'll be somebody who is friendlier to the industry, who will remove some of the roadblocks that we have seen. Will we get the strategic Bitcoin reserve, whether it just holds Bitcoin or buys Bitcoin?
That's just wild.
That's one of the questions.
A strategic reserve of Bitcoin?
It is wild. But you know what my biggest question is as we move forward here and you've got that institutionalization of Bitcoin, will we stop or hear less of people talking about Bitcoin like it is a religion rather than an asset class? I mean, you and I have talked to a lot of people who see it as
like changing the world order.
Changing the world. It is a faith-based asset and has been for many years. It has value because people believe it has value, and now more people believe it has value, or at least are willing to bet on its going higher. So will we see less of that sort of like language around
Which
it?
I always found fascinating because, as Mark brought up to me, or reminded me, I should say, there's a lot of bad actors in this space. I think a lot of folks think just because, FTX and all these folks got wiped out, that they're gone. No, crypto's still being used for nefarious activities around the world in many cases.
Yes, but the Bitcoin bulls will tell you, so is the dollar.
So
People use dollars for bad stuff.
That's what Mark told me.
That's what they are.
It's the dollar, man. Come on.
All right, let's talk about ETFs a little bit more now. Broaden it out to the equity space. Get a look at where to position next year after a banner year for U.S. stocks. Joining us now, Tim Urbanowitz, Innovator ETF's Chief Investment Strategist. Tim, it is good to see you here. So we've had a little bit of a pause in the so-called Trump trade now. But as we look ahead to December, how are you thinking about sort of the puts and takes here for the market?
Yeah, Julie, it's very interesting. I think you covered a lot of important stuff there just a few minutes ago. And I think when we look out next year, I think what gives us a little bit of pause is just the extreme sentiment that we're seeing really post the election. And the biggest risk that we see next year is that a lot of the stuff that investors have priced in, mainly around the policy side of things, do not play out. And specifically, when we look at things like tax cuts, there's a lot of enthusiasm that the 2017 tax cuts are going to be extended, that you're going to see a cut to the corporate tax rate. I'm not so sure that's going to happen. I think you have a lot of Republicans in Congress that aren't necessarily going to go for that unless they see it offset somewhere else, either cutting spending or increases in revenue somewhere else. So things like that, or even if the Fed doesn't cut at the pace that is expected right now, those are all risks just for the main fact that we see markets as really priced to perfection. And that doesn't mean that you can't see the equities continue to tick higher. We actually think that they will because sentiment will continue to improve and go higher, but we need to be wary and conscious of those risks, that there's a lot of good news priced in right now, and any disappointment, whether it be policy, economic, inflation, Fed, really has the potential to put some downside risks ahead in 2025.
Tim, I appreciate you showing up here on Black Friday with a couple contrarian thoughts, because as we all know in investing, nothing goes up in a straight line. But make it simple for folks out there. If they are inclined to think that the market is priced for perfection, and we may not get that perfect scenario, like what are the plays from an ETF land? How do you hedge your bets?
Yeah, well, we've seen a lot of interest across the options-based landscape over the last year. Within our lineup, we have particularly seen a lot of interest in our managed floor ETFs like SFLR and QFLR. And really, I think why these have become so popular is they really give investors the way to cover a wide range of outcomes. So SFLR on U.S. large cap equities seeks to provide a 10% floor against losses, while on the upside, you have exposure to U.S. equities participating about 75% of that upside. That's really important. And when we take a step back, Brian, and we look at just coming into this year, what analysts were projecting, I mean, the range of outcomes was crazy. The closest strategist that we track from major Wall Street firms was about 15% off where the S&P 500 is right now. The worst was about 43% off from where the S&P 500 is right now. So it just highlights, yes, it's good to forecast, good to try to figure out what risks and opportunities might be out there. But at the end of the day, covering a wide range of outcomes is really important. And that's where I really think strategies like SFLR, QFLR with the downside protection and upside participation really hold a lot of value for investors right now.
Well, Tim, let's stay on that because over the past 2 weeks, we've seen the likes of a Goldman Sachs, JP Morgan come out with a very aggressive S&P 500 targets for next year. I mean, do you think they're just being too crazy with these estimates? What do they need to pull back on?
Well, I don't necessarily think they need to pull back, Brian, but I think what makes 2025 tricky is the starting point for valuations, right? I think we're pretty confident that earnings are going to continue to grow and be a tailwind for equities, just given the backdrop. But what makes 2025 tricky is you don't really know what sentiment's going to look like. You don't really know what's going to push valuations higher or lower. We're of the mindset that the backdrop can be sustained. The economic backdrop is strong enough to sustain multiples where they're at. But can they be pushed higher? Can sentiment improve from here? Or like we talked about earlier, you see any of these items start to disappoint, you don't start to see those tax cuts extended, tariffs start to play an impact, that has the potential to drop sentiment and really drop multiples. So investors start to get disappointed. That's really the biggest risk that we see here.
Tim, what's your single best idea going into next year that might be able to do well no matter what happens with all those elements you were talking about?
Well, I think the two we talked about earlier, SFLR and QFLR, really more so on the equity side of the portfolio. But also our suite of 100% downside protection ETFs have also been very popular. We see those as very prudent in this type of market for investors who may be more cautious. So one coming out in December, ZDEK, the 100% one-year buffer ETF. You're looking around an upside cap of right in the 7 to 8% range on that strategy over the year. So still gives you some upside participation, but really takes any of those risks off the table altogether. So that one is very important, we think, for next year, especially for those investors that might be sitting in cash. It's a way to get that money into the equity market. And then another one, for investors that are more bullish and continue to think we're going to go higher from here, we've also been seeing a lot more interest in XUSP. This is a strategy that gives investors multiples on the upside. They give up right around the first 5% in gains, but then expedite those returns thereafter, and only 1-to-1 on the downside. So that's one that we've seen a lot of interest from clients that are very excited about the policy proposals that are going into effect, to be able to use that strategy, not take on more downside, but if we do see another 15, 20, 30% year, it's a way to really expedite those returns thereafter.
Julie, I'm just filling in today. I mean, could we have this guy back? He's showing up with tickers. I mean, this is just, you're speaking my language here, Tim. Appreciate you showing up prepared on Black Friday. I know it's a day after Thanksgiving. Tim Rabinowitz, Innovator ETF's Chief Investment Strategist. Good to see you.
Good to see you, Brian.
All right, coming up on Morning Brief, we count you down to the opening bell on Wall Street as we track the last trading day of the month. Plus, we bring you full coverage on Black Friday shopping as consumers head to the stores. And could your next Thanksgiving dinner be cooked by a robot? Yeah, well, it might be. Yes, it could. We'll discuss that and much more on Morning Brief. If investors have learned anything from retail earnings season this month, it's that e-commerce shopping remains super hot. So is anyone even out in the stores this Black Friday? Yahoo Finance's Kiko Fujita is on the scene at a mall in Glendale, California. Kiko, good to see you here. I know you already picked up my holiday season gift. I was looking for a new watch.
I'm in your favorite place, Brian, the mall, right? I mean, the mall here at the Glendale Galleria doesn't officially open for several more hours, but you've got a number of stores opening very early. Macy's behind me opening at 6 a.m. here on the West Coast. You've also got Dick's Sporting Goods, Target, and even Bath & Body Works opening early to try and lure in those consumers with some steep discounts. Here at the Glendale Galleria, they are expecting anywhere from 90 to 100,000 people coming through the doors here today alone. Now, they are expecting about a 4% bump in terms of traffic this year, and that's pretty much in line with what we have seen nationally. The National Retail Federation estimating Americans to shell out $980 billion this holiday season. That marks about a 3.5% bump year on year. It would mark the slowest rate of growth over the last 6 years, even as we've seen consumer sentiment slowly improve as a result of lower interest rates as well as moderating inflation. Now, retailers have offered mixed forecasts going into the holiday shopping season. Of course, you had Target lowering their outlook for the season after posting flat sales. And then Walmart raised its outlook, but we did hear from the CFO saying that he expected pocketbooks to continue to be stretched thin here. Moving forward, retailers have increased incentive to try and lure these consumers in with very steep discounts, largely because we have a shortened holiday season. Black Friday falling later in the holiday season this year, later in November. That gives retailers about 5 days less in terms of giving consumers that time to shop. The latest data from Adobe Analytics certainly points to the fact that some of these discounts are working, with American consumers spending $77.4 billion between November 1st and the 24th. That is a 9.6 bump year on year and higher than what was initially forecast. Shoppers we've been talking to ahead of Black Friday have been telling us, yes, they are seeking out discounts, but they're also turning to their credit cards and also buy now, pay later to pay for some of those discounts. Take a listen.
I'm just trying to budget and save money. Hours are getting cut a little bit, so trying to save and budget. So I'm just trying to use my Afterpay. I'll just pay it weekly or just pay it monthly. It helps a lot.
Adobe says buy now, pay later payments have driven $5.7 billion in online spending in the first 24 days of November. That is a near 4% jump from last year. And e-commerce, as you mentioned, expected to be a big part of this particular season here. Mobile shopping expected to hit records this season with $128.1 billion expected to be spent through mobile devices this year. That is 50% more than spending on desktops. In fact, half of all online spending coming through from mobile devices so far this holiday season. Guys, I know I have been seeing those discounts coming through, those alerts coming through online. I've spent a lot the last week, even before Black Friday. I'm not sure about if you guys have started your holiday shopping.
I've bought some things for myself, Akiko, but I haven't yet really started my holiday shopping in earnest. What I am glad is, right now it's nice and peaceful there. It feels like we are well past the days of when a store would open at 6 a.m. and people would pile in there and fight each other for things. I hope we're past those days. It looks like it there.
I still love doing that.
Of course you do. All right, Akiko, we will catch up with you throughout the show. Thank you very much. And we will also be speaking with the chief economist of the NRF, the National Retail Federation. That is Jack Kleinhans at 9:45 a.m. about that organization's holiday forecast. Sticking with Black Friday, though, retailers are rolling out the discounts to woo cautious shoppers in a shorter holiday season. Our next guest says she's already seeing more robust activity than anticipated among early shoppers. Joining us now, Pauline Brown, former LVMH chairman of North America. Pauline, it's always a pleasure to see you. When we look at the cadence of shopping here, and also who might be behind Akiko in that mall throughout the day, I was surprised that you observed it is actually younger people who want that bricks and mortar experience. As Saz and I were talking about during the break, those of us with busy lives, with kids, whatnot, we just want to get it done. We go online.
Well, yeah, we're seeing a few trends this year that are, let's say, counterintuitive. or counter to whatever logic we had in years past. And one of them is that older generations, baby boomers and Gen X's, are more than 50% likely to buy their products online, and well over 50% likely to do research well before they go in the store, so their store experience is efficient. Younger generations, and I'm talking about even Gen Zs, they're back in the stores. They want to be where other people are. They want any excuse not to be on their devices. It's become a social activity again, and I think that's why we're seeing some uptick in the traffic in these malls.
I just want to be very clear. All of us here right now, Pauline, Julie, we're all still young. Okay, I just wanted to swap the deck. I just wanted to get that off my chest here after Thanksgiving.
I'm in the mall,
yeah, okay.
so I can't.
Fair enough. So talk to me, Pauline, because I've been going into the malls. I go into the mall looking for some gifts for the holidays already, and the prices for luxury goods, gosh, they sure seem high. Has luxury pushed their prices too high this holiday season because their costs are still high? And if they have, is there a risk of a post-holiday inventory overhang that hits a lot of these companies?
Well, this is not an issue that has just come to the fore this holiday season. This has been going on for about 5 years. There's clearly been inflation across all consumer categories. Estimates are between 15 and 20% price inflation. For most luxury brands, that inflation has been over 50%. And there were two factors that were driving luxury goods, and this predates 5 years. This goes back about 10 to 15 years. One was the fact that as appetite for luxury was increasing, there was or seemed to be permission to raise the price, and some brands like Chanel and Dior were well over 50%, more like 70, 80% for certain items on the same items. These are not new items. And then the other issue, which has finally hit a ceiling, was China. There was very easy growth for these brands as long as China was growing as robustly as it had been, and it is not growing anymore. This year will be down, if a brand is lucky, to low single digits. So those two things have come together. It is making it a very challenging holiday season for many of the luxury brands. Not all, but for many of them.
Well, and Pauline, now, of course, you throw the threat of a ratcheting up of a trade war into that China mix as well. How are some of the luxury retailers that are still very China enmeshed, how are they trying to prepare for that?
Well, I think that the bigger issue than selling into China is going to be importing in from Europe and other places to the U.S. And it is TBD whether some of the export tariffs and import tariffs go into effect. But if they do, we're going to take already a price-sensitive customer. We're going to take a product line that has gone well above what the value proposition or the perceived value is to that customer, and we're going to add even more pressure. So I think it's going to be a tough couple of years for a lot of the luxury goods companies.
Pauline, well, then that takes me back. I was going back and reading a little bit more on the Capri Coach or Tapestry deal that didn't go through. Should something like that be re-entertained in this new administration? Don't these retailers have to combine? If we're dealing with these higher costs, doesn't something have to happen here for these to be viable companies the next decade?
Well, it probably should, because there are companies like Capri that will not fare well as a standalone, and we're seeing that reflected in the stock price. I don't think in that particular case they will re-entertain it. For one reason, because Tapestry, which was leading the acquisition, has only benefited from the fact that it has fallen apart in terms of their valuation. And they have said publicly that they are completely terminating the original construct. Do I think that there are other American brands that under a more friendly trade administration might consider? I mean, the reality is that most of these luxury brands, the vast majority of them, are not American. Right? Even an American brand like Tiffany is now part of a French conglomerate. So there are not that many brands to consider this. Maybe at the mid-tier and the lower end, where we do have a pretty robust American base of retailers, there'll be some consideration, but those are not the ones we're talking about with regards to this conversation.
Well, and Pauline, just to end on sort of zooming out here and your impression of American shoppers' willingness to spend right now, given the fact that we've seen inflation where it's been over the past few years, given what we've heard about what they're willing to spend on stuff versus experiences, et cetera, what's your sort of top line view of all of this?
Well, I'm actually kind of optimistic for most of the players, and we've seen it just in the last week. I mean, Nordstrom beat expectations, Urban Outfitter did quite well, Abercrombie and Fitch continues to build momentum. So among those retailers that are executing well in store and online, and among those consumers that may feel some price pressure, but still are gainfully employed, excited about the outcome of the election, or at least the outcome of an uncertain period, which is now no longer uncertain. I think the activity is pretty robust. I think how people are spending is what we should be watching for. So the aggregate amount of spending, I think, will be fairly healthy, whether it's somewhere north of 3%, 3 to 4% growth over year over. But within that aggregate number, we're going to see some clear winners, and we're going to see quite a few losers as well.
Pauline Brown, former LVMH chairman of North America. Always good to see you. Happy holidays.
Thank you. Happy holidays to you, Brian.
Thanks. Coming up, it's the opening bell on Wall Street when Morning Brief returns.
That's the opening bell. So let's see where markets have opened up here, as everybody is cheering post-turkey on this Black Friday and ringing the opening bells on the Nasdaq and the New York Stock Exchange. It looks like we're setting up here for a positive open after a little bit of dip in the major averages. The Dow right now opening up about 87 points, call it just shy of 90 points, about 0.2%. The S&P 500 up about 0.1%. The Nasdaq, which usually takes the longest to open, it's got the most components in it. So it looks like that is up about 0.1% as well. So a little bit of a tepid recovery here to start the Friday morning, and what has been sort of a choppier trade over this holiday shortened trading week, as folks are still trying to figure out what to make of the policies of the incoming Trump administration. We know now that the Trump economic team has mostly been named at this point, including Scott Bessent as Treasury Secretary. The markets were broadly cheered by that pick. But, still trying to figure out what the effect of tariffs are going to be and the effect on specific sectors. So that's what we're seeing sort of high level here this morning as we get underway. To drill down a little bit, we get over to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Hey there, Julie. Well, let's take a look at the Russell 2000 small caps Black Friday. I don't know that there's an obvious tie-in, but we're going to roll with that. And we've seen small caps kind of come alive recently. It's taken a while, just shy of a record high. We hit an intraday record record high. Didn't get the closing one earlier, and I want to say last week, but it's probably earlier this week. And here we are. Here's a 5-year chart, and you can see we are right back to these prior highs. So potential excitement here when we finally get that breakout, but it doesn't have to happen immediately. So let's go to the 10-year, which is now hitting the lowest since October. And this is significant because it was putting some upward pressure on risk markets, or I should say some downward pressure on risk markets as it went up. And you can see these local highs here hit about 4.5%. It is now down to 4.2%. That's a big drop, 30 basis points. And so that takes pressure off, as does the declining dollar. And that's another story that we've been tracking here. That's just down a little bit today, but I think traders will take that. And let's take a look at how the sector opened today. It was the cyclical sectors before the market opened and after the market opened as well. We have industrials, financials, those are the two leaders. Energy, consumer discretionary, materials. Looks like utilities is making it to the top of the shelf there. And then communication services is the only sector in the red. That's down by about 0.1% here. And let's take a look at Bitcoin, because we've been tracking this meteoric rise to 100,000. Didn't quite get there. It got just shy of it, came all the way back down to about 90,000, and now it is back to 97,000. So kind of a nail biter here. Are we going to get that final push to 100,000 today? Over the weekend remains to be seen, but we have seen the ETF flows kind of track the price action here, and that's always good to see. I think something like 9 billion in flows have been tracked in the last month alone. Most of those, 7.5 billion, 7.6 billion went to IBIT. That's the BlackRock iShares offering there. But in general, crypto has seen a tremendous uptake in those ETF flows. 3/10 of all the flows have happened in the last month. So a lot of excitement around crypto right now.
Good stuff, Jared. Thank you so much. Appreciate it. It's time now for today's strategy session. U.S. stocks poised for one of the best years in the S&P 500's history. But what can we expect for next year? Joining us now is Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist. Good to see you, Rob. We were talking in our morning meeting this morning a little bit about, have we seen the best of markets so far? Has the markets, December markets tend to do pretty well, but are we just at peak here? I mean, I can't see where we're going to get more catalysts to move this market higher, but maybe you see them.
Well, yeah, I think as we turn the calendar, some of the things that have been driving us this year continue into next year. Things maybe are not as robust as we've seen in terms of economic growth in 2024. It may be a little slower in 2025, but the consumer remains strong. The labor market remains robust, and obviously it's a very important report next week on the labor market as we head into the Fed meeting. Additionally, right, the artificial intelligence story continues. We're seeing those benefits start to broaden out. As Jared pointed out, the cyclicals are doing better, and that trend has been happening post-election. And then the last thing I'd add is we haven't really seen the Fed cuts start to work their way through the economy. They're modest for now, but those cuts by the Federal Reserve, the European Central Bank, the Bank of England will start to provide some support to this global economy. So I think there's some room for improvement. Will it be quite as robust as we've seen this year? Probably not, but there is room for improvement into the new year, certainly.
And Rob, speaking of your purview being global and you guys looking at the global picture, given what you're seeing, are U.S. stocks still the best place to be when you look at stock markets around the world?
Yeah, that's a great question. We do still have a slight bias to the U.S., but we are seeing some opportunities, particularly when you think about the cyclicals looking around the rest of the world. Things are certainly more inexpensive if we look at Europe, if we look at Asia. Those markets have really not participated quite as much. So we think there's room for improvement there, and that's someplace we would look for investors to maintain a toehold. Right, they don't necessarily have to have a more robust exposure in those economies, but we would recommend people start to take a look around the world as we see more beneficiaries from rate cuts emerge.
Rob, I hear you on the AI trade. The fundamentals still look strong, but you look at some of the valuations on these names, whether it's a Microsoft, an Alphabet, they look frothy to the passer, just to the average investor. Do they look frothy to you? And then if you own these stocks, what should you do?
Yeah, no, it's a great question. They're on the high side, certainly. The thing that's really helped them, though, in 2024 and as we head into the new year, is earnings are following, right? We're on the high side of multiples, but not really frothy if we go back to, say, what we saw in the late 90s and early 2000 with the valuations there that were multiples on zero earnings. These are companies that have earnings and are growing earnings. Can they grow them as fast as they have over the last year? Probably not. I think it's tough when you're talking about the size of these companies that we're getting to continue these 30+% revenue growth paces. So the pace may come down, but those earnings are really supporting these companies, and I think that allows these multiples to stay on this high side, particularly because we're only getting started with this artificial intelligence revolution, right? We think this is going to play out over multiple years. So they may not be the best performers next year. I think it's always tough to repeat. But there's certainly some value here through time. We'd look for people to get more diversified in their portfolios. They don't need to just own these names. They really should start to look to some of the other beneficiaries in this economy, like that have not participated quite as much, including financials, healthcare, utilities, other things like that. But we think there's still more room to run.
Let's drill down on some of those other groups that you mentioned, Rob. Healthcare is such an interesting area because obviously it's quite diverse within healthcare. It's a big bucket. And the policy from this incoming administration, I don't know quite what people are expecting from it when you talk about those different areas. Is there one part of healthcare that you think is going to benefit more or at least be a little bit more insulated?
No, I think the challenge with healthcare is it is a security selectors market, and that's not something we do very much. It's a security selector, but there's value here, right? These are companies that have had a tough time in the last couple of years, and there's probably room for improvement. So we wouldn't narrow down to the industries within that sector for this moment, but we'd look more to securities because there's certainly room to run, right? And it's been tough for some of the recently for some of the pharmaceutical names, for some of the biotech names. So there's probably some values to be found here. Gotcha.
Rob, good to see you. Thanks so much.
Thank you so much.
Rob Hayworth of U.S. Bank Wealth Management. Time now for our chart of the week. Saz has got more on that. So what is it?
Yeah, Julie, with markets trading at record highs, one thing that I always do, I just go to Yahoo Finance and I type in various ticker symbols. I scroll down onto the stats page and see what are some of the price to earnings multiples some of the world's most popular stocks are trading at. And this time around, I was looking to be surprised a little bit. So I locked in on a couple names. You see Macy's and Walmart. It is Black Friday after all. I wanted to make it a little bit of a theme. And of course, one of the most beloved stocks in the entire market, NVIDIA. It is one of our top tickers here today on Black Friday. That's NVIDIA. So let's do a little PE ratio rundown. First up, what in the world is a PE ratio? Now, it's something I think a lot of us in business news take for granted. It is basically what you're willing to pay for a future stream of earnings. Right now, and I would say this is shocking, even considering the Macy's stories, the PE ratio, the forward PE ratio on Macy's is 5.8 times. That is totally paltry. I mean, we all saw the Thanksgiving Day parade yesterday. This is a storied, iconic American company trading at 5 times forward earnings, of course, because it's various troubles. It's closing stores. It's trying to restructure. I should remind you, everyone out there, that the S&P 500 is trading on a forward PE multiple of about 23 times. So this is a big discount for Macy's because the market doesn't see this company growing anymore. Next up, Walmart. Let's check out that PE ratio on Walmart, 33 times. That is more than the S&P 500. To me, that is absolutely shocking because Walmart is not this big upstart growth company. I mean, this is a multiple you almost signed to a tech company. But you take a step back and you see Walmart has been having a very good year on e-commerce, growing in over 20% a quarter. Same-store sales are crushing target. The company is doing well, big profits, big guidance raises. The holiday season is supposed to be strong. So maybe I shouldn't be too surprised to see this stock trading at a well above market multiple. But wow, that is Walmart. And last but not least, of course, had to mention NVIDIA, one of our favorite tickers. Interestingly, NVIDIA's PE ratio is trading below that of Walmart. And I am surprised, one, to see that, but also secondarily, NVIDIA is growing its earnings by almost 100% a quarter, probably going to grow earnings in 2025 between 70 to 125%. So to see it trading at about 31 times, to me, Julie, is a little bit of a shocker.
You know, this inspired me to look at some PE ratios, forward PE, and we're talking forward PE, we should mention, so it's estimated earnings going forward. Tesla, you want to take a crack at what Tesla is, Saz?
Tesla, 51 times.
97. But the one that probably takes the cake, and the real explainer why a lot of analysts have gotten cautious on this name, Palantir, at nearly 143. But even though a lot of analysts say that valuation is too high, the stock keeps going up.
It's important. Let me, real quick, Julie, that PE ratio matters. I know a lot of folks on Yahoo Finance, they love Palantir. It's one of our favorite tickers. And they think, valuations don't matter. Let's trade that stock. They do matter, because when Palantir reports over the next couple quarters, it is a stock price for perfection. Any number is likely to hit Palantir hard.
We shall see how that plays out going forward. Saz, thanks a lot. And straight ahead, we're staying on all things retail and the consumer here on Morning Brief. We're back with the chief economist at the National Retail Federation. Don't go anywhere.
The National Retail Federation expects Americans to shell out $980 billion this holiday shopping season. That's about a 3.5% bump online and in store. It would mark the slowest rate of growth in 6 years, it's worth noting. Joining us now, Jack Kleinhens, National Retail Federation Chief Economist. Jack, good to see you here. Prices for merchandise this holiday season, even considering the promotions, seems high. How do you think the consumer is going to react to that?
Well, happy Black Friday. And you did mention that we are looking at 2.5% to 3.5% growth. In fact, I expect it to be at the upper end. So when you ask about prices, actually, retail prices have been down on a monthly basis on a year over year by almost 1%. So at this point, prices are very competitive for retail purchases this holiday season. And we think that the underlying state of the economy is in a good place. So despite interest rates and still some elevated inflation, we're kind of confident this will be a very good holiday season.
Jack, are those prices competitive because of discounting, right? And so then does that have implications for retailers' margins if they're still paying what they have been paying for the wholesale product?
Well, certainly margins enter into the calculus for pricing any merchandise, but I'm looking at the BEA data just released on Wednesday. When you start looking at it, while margins might be a little bit tighter, and of course, this time of the year is when discounts and promotions are at the highest. And so, excuse me, how you can project forward in terms of earnings, et cetera, it's really difficult at this point.
Jack, it's very likely that we will get tariffs next year. Will they put the consumer, will there be a consumer recession as a result?
Well, that's a great question. And of course, the tariffs that were placed on back 4 or 5 years ago, or the previous Trump administration, were tariffs on intermediate goods. So they weren't on consumer goods. Our analysis so far that if there is across the board tariffs adopted on consumer goods, it would really put pressure on family finances, and as much as $78 billion annually that would reduce consumer spending. So the concern I have, obviously, is we've been making headway on inflation, and this should definitely reverse that trend. But more importantly, it would likely result in job losses. How much of an impact? Certainly at this point, I can't say if it will be recessionary. There's just too many unknowns. Trade is a two-way proposition, and you will see countries will retaliate. So it could very well be significant pressure, but nonetheless, the American consumers are the ones that we're most concerned about.
Yeah, and obviously there's a lot we still don't know, Jack, in terms of whether they will actually go into effect, whether it is indeed a negotiating tactic, as some have assumed. When you're talking about that $78 billion number, which is obviously a big number, is that assuming that 100% of the tariffs are passed on to the consumer or some other percentage level?
Yes, that's a great question. This study was done back very shortly after the election. And it really basically is an adoption of a universal 10 to 20% tariffs on imports from all foreign countries, and then the 60 to 100% tariffs from China. And so it would impact in retail about 6 categories. So to break it out any further, I think it just shows you I'm sure you've seen, there's probably 20 other studies that have been released since the announcement on tariffs right after the election is showing the impact is relatively heavy on consumers. And so we'll have to see, as you just mentioned, how it gets used, whether it's a negotiating tactic or if it just gets put in place,
right.
Broadly speaking.
Jack, finally, I want to close out by getting back to Black Friday, because I think for those of us who've been doing this a while, right, Black Friday used to be the day, right? It's called Black Friday because way back when, that was when retailers got in the black for the year. How important is Black Friday at this point for retailers and for the cadence of consumer spending?
Well, it's very difficult to measure precisely how much will be spent. And over time, as you've said, you've been around for a while like I have. I've been monitoring the consumer for closely 4 years. And look at all the changes that have occurred. In particular, the use of online shopping and certainly the ability to find things through the internet and the changes that we've made. So we can only gauge that it's still very, very important from the standpoint today that we expect about 23, 24 million people will be out shopping today. So this 5-day period, though, when you start thinking about Thursday, Friday, Saturday, and of course Cyber Monday, it is the bulk of spending that we believe is critical to the retail industry, and in particular for the holiday season.
Jack, good to see you. Thank you so much, and happy holidays to you.
Thank you, and you too.
Thanks. Jack Kleinhens is National Retail Federation Chief Economist. Coming up, we're talking about the future of robotics and whether the market could be worth billions or even more in the coming decades. We'll be right back.
The number that we got to is 13 million in unit number by 2035 and 650 roughly by 2050 is the number that we got to in terms of units. And if you multiply by the pricing point that we are currently looking at is around 20 to 30K US dollars, and we are expecting it to gradually goes down a little bit in the future, but I think by 2050 we are looking at a $7 trillion market for humanoid.
That was Wenyan Fei, Citi Global Insights analyst, who really put out a really interesting piece of research with Rob Garlick, who works at Citi. And look, you want to poke holes in this, and I get it. These things still seem very sci-fi-ish, but there are 50 companies, according to Citi's research, they're not only making these robots, they're actually out there selling them. And some of them do seem like a stretch. You can see some of where these robots are now being used in the market potential, but there are robots now that can do your laundry. These are real things that are actually doing stuff. And what we talked about here was that maybe, we will have that personal companion.
Well, listen, there are robots and there are robots, right? Like there's Chippy the robot, right, at Chipotle, which makes chips, but it doesn't look like a person.
Correct.
It is just an automated, and it's also not a smart robot. Mm-hmm. There are robots that have been in the U.S. manufacturing process for decades. But
I think what Citi is getting at is there are, first of all, this is humanoid robots that actually look like human beings that can climb stairs now. That might be the butler or take care of your aging parents. They looked at that as one of the plays too as well. Look, here's the photo. Michael Dell on Thanksgiving. I was scrolling X And Michael Dell puts out this photo. I mean, is that the future of Thanksgiving here, where that robot, we'll call him Saz, is making Thanksgiving dinner? I mean, it could be possible. It could be possible.
I mean,
a lot of this technology exists already, Julie.
Lots of things are possible. But I don't think that robot is going to be making our Thanksgiving meals anytime soon. Look at this. Here's the evidence for you.
Okay.
Tesla's much vaunted cyber cab event. Those robots had people giving them orders and talking through them. They were not ready for prime time.
I want what I'm getting, and I'll talk with Sunday morning. I have a deep dive on this on my morning brief newsletter. We'll talk more about robots. I got some infographics in there. I got the full interview with the city folks. There's more going on here besides Tesla robots, and I'm all down for a butler. I mean, make my laundry, make my bed. There is a robot that can make beds actually already.
Great, fantastic. All right, that does it for the morning brief. Join us next for more analysis on Catalyst.
Welcome to Catalyst. I'm Brian Sozzi alongside Julie Hyman. We're about 30 minutes into the shortened holiday trading day. Let's get to the three catalysts we're watching at this hour.
First up, we bring you the latest on the tech trade as the market darlings lose some of their luster.
Plus, we hone in on the holiday shopping season, what it means for the retail sector.
And we focus our attention on the state of the consumer and what that says about the U.S. economy.
The Tech Select Spider XLK on the Yahoo Finance platform is looking, well, a little in the green here on this abbreviated trading day after falling nearly 1.5% ahead of the Thanksgiving holiday. The top 3 holdings in here are Apple, Microsoft, and Nvidia. All have underperformed the S&P 500 in November. That is, in fact, news you can use. We're also looking at Nvidia, one of our most popular tickers here on Yahoo Finance. That stock getting a boost on the final trading day of the year. Interesting, Julie, to see Nvidia underperforming the S&P 500 November day. And this is an Nvidia.
Yeah, I don't know how much we should make of that.
I'm with you.
I don't know. You know, I think that since the election, there's been a lot of, NVIDIA sort of existed in its own universe, right? We saw it fall after earnings and then recover. There's been a little bit of confusion over what the path looks like ahead because of some of the friction in making its very popular Blackwell chips. But I think that there's just a lot of uncertainty out there, and we've seen the broadening of the rally. So does the underperformance of tech have more to do with tech or more to do with people looking elsewhere for the next leg up of upside?
Yeah, I think a lot of folks are starting to call out, they are, to your point, looking for a broadening of the rally. But if you look at some of the big cap tech names, they have not had a good November. And if you zoom out even more, they haven't had great 3-month performances. And then I love this word, you're gonna dig this. If you double click even further, the semiconductor stocks, they have been really underperforming. Strip out NVIDIA, a lot of those names underneath the surface, the charts have completely broke down. And for me, I do wonder if they're sending a signal in the first half of next year. Don't know what that signal is yet. Growth slowdown, overvaluation, unclear, but it's worth noting.
Well, there's a lot of overhang risk here, potentially from tariffs, right, which could hit the semiconductor industry. We're going to talk more about them later. But also, you know, there was a report by Bloomberg going into the holiday that the FTC was looking into Microsoft, right? You have obviously regulatory scrutiny for Google. And I think it's not clear that those things are going away with the switch in administrations. So for the first time in a long time, I mean, listen, regulatory scrutiny of the tech giants has been talked about for years, but it's the first time in a long time that they seem to be really working their way into conversations around these stocks in a more immediate fashion and maybe putting a little bit of pressure on.
Yeah, it does. Like, it feels like we were talking about this many years ago, but still nothing has happened. But all these companies have gotten more powerful. So what if Alphabet has to strip off the Chrome browser? I mean, they're dominant in so many.
No,
you think it's a big deal?
It's a big deal.
Yeah,
it's a big deal if they have to get rid of Chrome. I mean, listen, Australia is saying that, like, if you're a teenager, you can't go on any social media.
Mm-hmm. That's a big deal.
It's a big deal. All right, let's turn now to some interesting investment plays to consider as the market rally potentially broadens beyond big tech into 2025. Thomas Hayes is with us. He's the chairman and managing member of Great Hill Capital. Tom, it's great to see you. So we were just talking about that broadening trend. If you had to pick now between large cap tech and everything else, what are you picking?
I think you follow the earnings, Julie, and thank you for having me on. What we've seen since the first quarter of this year is the Mag 7 earnings growth has decelerated from 50% earnings growth in the first quarter of this year to mid-teens. And what we're also seeing is the unmagnificent 493 have accelerated from negative aggregate earnings growth to positive, and by early next year, they will be low double digits to mid-teens. So you want to follow the earnings and the unmagnificent 493. I think that's where you're going to see things happen.
Tom, it's good to see you. It's been a little while. Look, it's a holiday shopping season. Give people some presents in terms of some stock picks. What do you like? What don't you like?
Well, I think the biggest surprise of 2025 is going to be that bonds get bid. Okay, we've seen since Scott Bessent was appointed as Treasury Secretary, and he put in his 3-3-3 plan, the 3% real GDP, budget deficits below 3%, and add 3 million barrels per day. Bonds have yields have come in, so that's an opportunity to buy a little longer out on the curve. As for stocks, as for Christmas presents, I got a perfect one for you. Actually, maybe two if we have time. I've got Etsy. Etsy has been left for dead. Etsy was a COVID darling. The stock is down 85%. But what most people don't realize, it's the third most trafficked retail website, 92 million users. And what's really interesting about that, Brian, is that they don't compete. It's not a race to the bottom on prices, because the things you can get on Etsy, you can get nowhere else. And this is a company that, while the stock is down 85%, they've been able to maintain all the users they picked up during COVID and maintain the free cash flow generation is re-accelerating. 600 million plus trailing 12 months, $1 billion buyback authorization, growth in international, growth in men's, growth in gifting, growth in loyalty programs. We like this one.
And of course, now I'm seeing Brian Sozzi next to me,
I
commencing his holiday shopping by going on Etsy.
I'm looking at digital prints. I mean, maybe you're right here, Tom. I can get a digital print of my non-existent puppy and put it right there on my desk.
You
I mean, this what Etsy's showing here is Bailey the puppy. I mean, it's great.
So, Tom, let me ask you, though, because one of the reasons that the stock has taken such a hit has been sort of concerns about that it hasn't maintained that level of specialness, right? That there are counterfeit goods on there, that it's not as curated, et cetera. What do you think about that? Do you think Etsy's been doing a good job of sort of addressing some of those concerns?
No and yes. No, they haven't been doing a good job. That's why the stock's down 85%. Yes, they recognize the mistakes they made and they're fixing it. And that's why we're seeing a re-acceleration of growth, revenues, proper initiatives, curation, and an abandonment of what they were doing, which was trying to compete with people that they don't compete with. You know, Brian, when you go out to get that picture of your puppy, you want to engrave the recipient's name on that picture, and it will make them feel special. I mean, when you receive a customized gift from a friend or family member, it's special because they took extra time, they were thoughtful about you, versus just scattershotting 20 chocolate baskets from Amazon is not the most ideal situation anymore.
And now I'm going to have to get a puppy. I don't have one, but I just want a puppy. I want to take a photo of it, and I want to share it with all of you. Tom, before you came in here, Julie and I were having a chat on tech stocks and seeing some weakness in the semiconductor names. Is there any read-through, any cautionary signs from some of these stocks that were some of the favorites amongst investors now getting tossed in the trash?
Well, as it relates to NVIDIA, we saw a lot of retail investors chase into that after the split. They got some benefits, but you know, at the end of the day, you have a stock that's priced for perfection, trading at some 40 times sales, 40 times forward earnings. A lot has to go right. And the problem is there was a period in time when NVIDIA, the stock price went up and it actually got cheaper because the multiple went down. That is no longer the case because profit margins have capped out. Revenue growth has capped out at a measly $4 billion a quarter, which is still absolutely incredible. But the key is price is what you pay, value is what you get. And at 40 times sales, as we move from training the models, which is where GPUs are the most critical and the spend for GPUs is the most important thing, to the more efficient part of the AI process, which we're slowly shifting into, which is inference. Inference can be done on more basic chips with lower energy use, lower demand, more chips, but lower quality chips. That's where the AMDs of the world and the Intels of the world are going to start to arise from the dead, and the pie is going to be split up a little bit better. So on that basis, maybe they can eke out a couple more quarters of stock growth, but where it's priced, I think it's certainly makes sense that it's consolidating and stalling a little bit and maybe even pulling back.
I want to come back to your bond call, because I find that kind of interesting, Tom, because there are, of course, all this talk about tariffs maybe keeping rates, meaning that inflation is going to stay higher, meaning that rates are going to stay higher for longer. We're not going to see as many cuts. How does that factor into what you're expecting?
Well, this was the exact same thing that happened in Trump 1.0. He was elected in November of 2016. The first thing you saw was, oh, it's going to be inflationary. He's going to spend. He's the debt king or the bond king, and immediately long end of the curve sold off aggressively after the election and into his inauguration. And it was kind of sell the rumor, buy the news. When he actually got in, bonds had a meaningful rally in 2017. Same thing with the dollar. As soon as he was elected, it had this knee-jerk strength all the way into January, into the inauguration, and then weakness. And I think those are going to be two big surprises in 2025. Bonds get bid, yields compressed, dollar actually re-weakens. Maybe not the next few weeks, but as you look out 6 to 9 months, that will be the case. And if you look at the inflation during the Trump 1.0 administration, it was subdued. There were a lot of different conditions. I'll give you that. History does not repeat. It does rhyme. But the other thing that was odd about 2017 to 2020 is emerging markets did exceptionally well. When he was a pro-tariff, the tariff king, he ran on the tariff king, and emerging markets had really tremendous rallies as the dollar weakened. So I would be open-minded. And the other thing that people think, energy is going to do great. Energy did very poorly under the Trump administration, and so did retail stocks. After initial rally into the inauguration, retail stocks were very weak in that first year, probably on the fear of tariffs as well. So I would just be burdened by the facts and the data versus the hearsay of what might happen or perceptions about what would happen. Look at what actually happened and see where the conditions are similar and where they might be different. And I think there's a tremendous opportunities in the next 12 months in doing that.
Thomas Hayes, Great Hill Capital Chairman and Managing Member. Always good to see you. Appreciate the picks. Appreciate the puppy suggestion. We'll talk to you soon.
Thanks so much, Brian. Thanks, Julie.
All right, now time for some of today's trending tickers. Scan the QR below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We're honing in on the chip sector as those stocks get a bit of a boost today. On a report by Bloomberg, the U.S. chip curbs on China won't be as bad as some have feared. And Julie, I think this was something you were just referencing here.
Yeah.
Maybe good news for the chip space?
Yeah, I mean, again, you have to, with any of these reports, the caution has to be, we do not know, right? But that this is reminiscent of what we saw in the first Trump White House, where you saw stocks sort of whipsawing sectors, individual stocks whipsawing on these various reports. So according to this report, we could hear new news on this as soon as next week, and that the caution, even in this report, is that things have been changing. So we could see them change again before they actually come out here. And we should mention also that this is coming from the Biden administration, not from the incoming Trump administration, that there could be some kind of curb on sales of semiconductor equipment and AI memory chips to China, but maybe not as bad as had been feared.
Yeah, I think investors are getting a taste of how December and early January, at least ahead of the inauguration, may look like. Headline drops like this, various news drops. Just stay skeptical, a lot of these reports. And remember a lot of the fundamental drivers of these companies. NVIDIA is still selling a lot of chips. They're leading the AI revolution, so, you know.
Well, I mean, NVIDIA also, and many of its competitors, have adjusted to the existing export controls, tariffs, et cetera. Of course, NVIDIA makes a not as advanced chip to sell into China for that very reason. The fear was, as the curbs get bigger and bigger, would it be more difficult for them to deal with some of that? And I think we're just going to have to see what comes out of the administration. I mean, you know, when I talked to Qualcomm CEO Cristiano Amon, he made some similar comments where he said, you know, we've dealt with it before, we will deal with it again. They've sort of had to get used to all these ins and outs and the increasing, whether it's tariffs or some of these other kinds of export controls.
And it should be a fun year for a lot of public company tech CEOs. All right, coming up, we'll head back to the mall. Yahoo Finance's Akiko Fujita to see if anyone is out there shopping on Black Friday, which is not a given in this age of online shopping. We'll be right back.
There's people there.
There's Akiko. Days of breakdown, doorbuster, Black Fridays may be behind us, but brick and mortar stores are still rolling out the promotional red carpet to woo in shoppers. Let's check in with Akiko Fujita, standing by at a mall in Glendale, California. All right, Akiko, you've been there for a little while now. Tell me you see some humans out there buying.
Yeah, there's a fair amount of foot traffic out here, Brian. We are inside the Glendale Galleria. The mall itself not expected to open for a few more hours. We are early here on the West Coast, but we've seen a number of stores, including Macy's behind me, Target, Dick's Sporting Goods, JCPenney, all opening their doors at 6 a.m. And those shoppers who have come in early certainly get a bit of a payoff. They're giving out these $10 gift cards here at Macy's for those early risers. Certainly, we've seen doorbuster deals in places like Bath & Body Works as well. In all, the Glendale Galleria expects anywhere from 90 to 100,000 people to come through these doors today to take advantage of those deals. You look across the country, the National Retail Federation expects 183 million people to shop online and in stores over this extended holiday weekend, but 2/3 of that coming today on Black Friday in store. Now, part of the reason we've seen these retailers really try to entice consumers with coming through the door is in part because of where Black Friday falls this year. Because Thanksgiving came later, retailers have 5 fewer days to bring shoppers in. And we've been speaking to a number of shoppers who've said that's the very reason why they opted to shop in store this time around.
Ordering online, you don't see the product, so it's better to see it in person. So I think some people prefer that way. Some people don't like the shipping and all the waiting, and then if it doesn't fit, you got to return it. So it's like a longer process.
Well, there's no question Americans are increasingly turning to online to get all their shopping done. Adobe forecasts consumers will spend a record $241 billion for gifts this year. That is a near 5% jump, 5% bump compared to 8.5% bump compared to last year. A majority of those orders coming through from these very devices. I've done it. Many shoppers, especially going online through mobile to get their shopping done. In terms of what Americans are buying, electronics, a big winner, as it always is during the holiday season. About $17.7 billion is what Adobe is seeing. That's about 11.4% growth year on year. Apparel and grocery, the only categories that are outpacing electronics in terms of growth. Now, we've been talking to a number of shoppers to gauge consumer sentiment. The data at least shows that sentiment is improving with inflation moderating, lower interest rates as well, but increasingly consumers telling us that they are shopping, but they're also shopping on their credit cards as well as buy now, pay later. An interesting stat for you here from Adobe. Buy now, pay later payments driving $5.7 billion in online spending in the first 24 days of the holiday shopping season. Remember, it's a little more extended this year, so we're talking from November 1st through the 24th, and that's a 4% jump compared to where things were last year.
So big numbers there, Akiko. I'm curious, just anecdotally there, the people that you're seeing at the mall, is it families? Is it older? Is it younger? Is it female? Is it male? Like, how would you characterize the crowd?
Yet, I've seen a lot of families out here. That was a little surprising to me. 6 a.m. I don't know what time they went to sleep yesterday after their Thanksgiving meals. We saw a family earlier with their baby going through Bath & Body Works. And what we're hearing from them is, they're buying for their families, but they know that coming early, number one, you don't have to deal with the lines because not everybody is out so early, but they're also finding a decent number of discounts out there that are those sort of traditional doorbusters. At Macy's, I just did a walkthrough there. There's a lot of cosmetics that are discounted, not something you see all the time. So different kinds of deals they're looking out for, but surprisingly, a lot of families out early.
Akiko, thanks so much. We'll check back with you in a bit. Well, Americans, as we've been hearing, they're ready to spend this holiday season. Holiday budgets are more than 30% higher this year, according to estimates from JLL. With more on what to expect from shoppers, Naveen Jaggi is joining us now. JLL, America's president of retail. It's good to see you, Naveen. So from what you are hearing from shoppers, and in particular, you're dealing with people who are out and about in physical bricks and mortar locations. What have you seen as some of the trends or changes this year over the last several years?
Well, I think your reporter said it just right. I mean, we have a shorter holiday season than we've had in the last 5 years. So as a result, with all the promotions we're seeing online, on our phone and on our tablets, people now have an incentive to go to the store more than ever. And we're still a consumer that likes to go shopping in person. So not surprised to see people at 6 a.m. at the Glendale Mall. I was at the Houston Galleria a couple of days ago where I'm based, and it was Tuesday afternoon, and it was buzzing, and it was buzzing with families, which confirms what we've all expected, that today more than ever, our consumers are thinking about buying the best bang for their dollar, and they're going to take their family with them to get the most for that dollar. Not surprising that you'll go shopping at a mall, because this is the time when the mall dresses up for the big events like Christmas. So I expect a lot of people to be shopping at the mall, using all the promotions and discounts that we're seeing heavily right now, because with 5 less days to shop, the pressure's on to find the merchandise you want to get to put under the tree.
Naveen, this is mostly upper income households, right? Because there's still a lot of folks out there living paycheck to paycheck.
Well, there are certainly, but where they're shopping at Walmart. We saw their results in third quarter. Walmart is leading the charge for that sector of the economy. And what we know is if you look at Walmart, TJX, Ross, Burlington, all those brands that play to that value-conscious consumer, that value-conscious consumer is finding the best bargains they can. So unsurprisingly, while we see the malls getting the weekend traffic, what we're going to see on a day-to-day traffic is that Walmart anchored shopping center, that Home Depot anchor shopping center, where you can get your daily goods and the stuff you want to get for the tree as well. So the value-conscious consumer will absolutely find great deals this winter.
And Naveen, you guys really have good insight into where retailers want to locate right now, right? And I'm curious what you can tell us about that. Where are you seeing the growth? Is it urban? Is it suburban, right? Are there particular geographies that are seeing a big uptick right now?
Yeah, so we're really dealing with a fascinating scenario where we have a historically low retail inventory. So retailers are now saying to themselves, where do we go find the best space at the best opportunity? The Sun Belt states, leading it basically from California all the way to Florida and Georgia, is where we're seeing the biggest interest from retailers. Some of these states are quite good at getting retail projects off the ground. So we're still seeing some inventory being delivered in Texas, Georgia, and Florida. But to just give you some sense of scale about what's happening in the economy today, we're delivering roughly 14 million square feet of retail space in 25. Give some context, back in 2006, 7, 8, and 9, we delivered nearly 200 million square feet per year. So that's roughly 1 billion square feet between 2005 and 2010. Today, 14 million square feet, of which 10 million of it is pre-leased. So that just shows how low the inventory is. So the point of this is, for retailers, you've got to go find your deal now and secure that deal. Because if you think you're going to get that deal at a lower price, a lower rent next year, likely not.
Oh, that's really interesting, Naveen. And you also mentioned, this is the time of year when the retailers dress up for the holidays, right? Is there increased pressure on the retailers to make something TikTok or Instagram friendly at the mall, that there is a higher onus on them than ever to make things sort of visually appealing to consumers?
100%. So we talk a lot about dwell time, right? And so we want now the consumer to not just shop, but we want them to stay a while. And so whether it's the shopping mall, and whether it's in Glendale or Houston or other markets around the country, we see more and more effort for what we call curb appeal. And the curb appeal means we want to make sure that consumer stays for as long as possible. So it has to be very, very appealing for the Instagram moment or the TikTok moment, and not as much about the bargain. Because as we've seen over the last 2 years, consumers more than ever today, they want that experiential opportunity as opposed to just finding the best price. And so that's where you're going to find a lot of money spent on these shopping centers, where they're going to make the curb appeal so fantastic with the Santa Claus and the visits and the Christmas parks and Christmas parades. This is the time we're going to spend the money. Because once you get the consumer's attention to come there, they'll say, that was fun for the family, mom and dad. We're going to come again and again and again. So I look for more money being spent on experiential opportunities for our consumers, because that's what we want to see more than ever. And our surveys show time and time again, consumers want not just sales, but experiences.
Naveen, really interesting story on the Yahoo Finance homepage from our senior reporter, Brooke DePalmer, looking at the state of department stores. And she flags that Macy's is trying to close 150 stores by 2026. I mean, how much pressure are those store closures by Macy's and, frankly, other department stores, how much pressure is that putting on the space?
That's probably the biggest thing to watch in the news today. We spent a lot of time studying the mall sector. And for us, we look at the mall sector as whether it's 150 Macy's or more, we don't know right now. But what we do know is that that Macy's store may be the last piece that keeps that mall alive in a secondary or tertiary city. And so if that Macy's folds, that may be the last domino to have that mall start to close up, or it may transition into something other than a mall. So if I'm watching one sector more closely than others, I'm watching that mall sector. Look at Nordstrom's, for example. I think they've taken their focus off their name brand, moved to Nordstrom Rack. They now, at Nordstrom Rack, are competing with whom? TJX, Ross, and the value-conscious consumer. So the mall sector in particular, the Macy's of the world, if you will, the department stores, I think that's the weakest sector of all in our economy. And I think that sector will probably feel some more pain in 26 and 25.
Naveen Jaggi, JLL, America's President of Retail. Good to see you. Have a good weekend.
Thank you.
Yahoo Finance spoke with several CEOs and investing pros this week about the potential impact of President-elect Trump's proposed tariffs. Take a listen.
I know it's a negotiation. I know, we shouldn't take it all that seriously. But on the other hand, broad-based tariffs, they're just a negative, what I call a negative supply shock. They're a tax, so they raise inflation and they diminish growth. Just exactly, the wrong policies.
Look what the NRF put out, that it could impact consumer spending by nearly $80 billion and require apparel companies to raise their prices by a double-digit amount. It is a headwind. It's not good for the consumer because it causes prices to be raised. And also, for many, the ability to garner that expertise in manufacturing goods.
Apparel is going to be hit the hardest. Most apparel is made in China, or a lot of it for that matter. Some companies have moved supply chains away from China, but it's kind of hard to avoid China.
Well, JCPenney is one of the retailers that's shifting its supply chain in anticipation of higher costs from tariffs. Here's what CEO Mark Rosen told us this week.
About 50% of our apparel is private label, meaning that we source that. And so we decide the country of origin where it's made. We've moved a lot of our goods to what we believe are going to be lower tariff countries. I am concerned, however, because there are certain goods that can only be made in countries like China.
And Trump's proposed tariffs on Mexico could spell major trouble for U.S. automakers with plants in the country such as General Motors and Ford. Here's what RBC Capital Markets analyst Tom Narayan told us about the possible impact.
The one that's the most hit would be General Motors, GM. They have the most production capacity in Mexico. If you did the math on a 25% increase on tariffs there, also they're just the most U.S. exposed, it would theoretically result in a down 8% on estimates. It's going to continue to pressure these names. We would advise folks to look past it because we don't think will actually happen. But unfortunately, it will just pressure stocks until we get some clarity.
Yeah, I don't think you can look past it. I mean, if you're at home trying to think about how much a General Motors or Ford or even a Gap or an Abercrombie can earn, I mean, you have to start at least playing around what an impact these tariffs could have on these companies.
Yeah,
I mean, this is real stuff.
Yeah, S&P Global was out with a report just this morning saying that European and American car makers, it could cost them 17% of their combined annual core profits. And that's in the event that the U.S. does impose tariffs on Europe, Mexico, and Canada. So, the various analysts out there are modeling out scenarios in case. But that's what's so difficult about this current environment is, we've talked to plenty of people who are assuming this is a negotiating tactic. But there's danger in that assumption.
Perhaps it's not. I was talking to earlier in the week with the Abercrombie & Fitch CEO, Fran Harris, which she was talking about earnings. About 9%, I believe, of their supply chain is still in China. Now, if there's any positive thing here, it's that businesses like that moved a lot of their supply chain out of China in the first administration, but there's still a chunk of it there.
Yeah, I mean, we heard the headline recently that Steve Madden is going to work on moving its supply chain because it's one of those retailers that kept a lot of it there. The issue is, yes, you would avoid the worst of the tariffs, but there's also talk about that universal basic tariff of 5%. So it wouldn't be nothing. It would just be mitigated.
Should we be buying our stuff now? I mean, there was that journal article. I don't think we're there yet.
I mean, you can't buy everything now. You don't know what you're going to need.
I don't know what we're going to need. All right, well, coming up, as consumers are on the lookout for deals, we're looking at where they're spending with intention as we close out the year.
fintech shopping company Rakuten has turned cash back into a business model worth billions. The company's latest data shows that in the fourth quarter, consumers are spending with intent. Sales are up 4% year over year, with the average purchase size 9% higher year over year. Joining us now in studio to break down these findings and some of the retailers that could be seeing a boost this holiday season, Julie Van Ullen, Rakuten Rewards Chief Revenue Officer. Thanks for being here, Julie.
Thanks for having me.
So what does shopping with intent mean?
It's a great question, and I think we always follow the data, right? And the data is showing us not just today, but today, yesterday, and over the last couple of weeks, what we've been seeing effectively since the election is that consumers are browsing less, but buying more. So when we look at our platform, we see decreased browsing, but we see increased sales, and probably what's driving that actually is the increased average order value. So consumers are clearly being very planful, very thoughtful around what they're going to buy, and then they just simply pull that trigger.
So maybe they're doing more research ahead of time, and then coming to make the purchase. Is that what the implication is?
That is what it seems to us. And I think that's very much in line with the fact that this is a season of value-conscious shopper, one who feels a certain amount of turbulence in the economic sphere. And so, of course, they're going to be out there making their lists, researching, and then waiting for that moment, that permission to buy, if you will, when it feels like they're getting the value that they're looking for.
Where are they shopping the most? What categories?
Interestingly, what we've noticed is a trend that I think that we're calling first me, then you. Which is that a lot of shoppers have been out there, yesterday included, and even as of this morning, as I monitor the categorical data, they're out there buying things for themselves. They're buying for non-traditional gift-giving categories like pet supplies or restaurants, even like CVS, Walgreens,
self-gifting.
They're self-gifting, exactly. So what we're really looking for is when is that going to potentially turn over to more of giftable moments today, through the weekend, Cyber Monday. But again, it's very much in line with the consumer who's really thinking about, hey, this is the time of year where I know that I can get value. Let me get value on the things that I need for my family and for myself before I turn to think about the gifts that I'll buy.
Yeah, like a stock up situation if something is going to be on sale. That's really interesting. I mean, speaking for myself, like my email inbox is inundated with offers, but it's not offers for gifts for other people. It's because I signed up for too many lists, and so now it's stuff that's targeted at me that I would want to buy. But what is sort of the takeaway for the retailers then? What are some of the lessons maybe they can learn from what we're seeing this holiday season?
I think there's a couple of things happening that they can learn from that are pretty different than consumer behavior last year. I think the first one is that there was a stark difference between the week before the election and the week after the election in terms of shopping behavior. We saw a 57% increase in shopping happening the week after the election versus the week before the election. And that has kind of continued in terms of the uplift in shopping trips happening in early Black Friday events. And that's been happening even before many retailers and brands entered into their big promotional periods, which I think tells them something, which is that the consumer is willing to pull the trigger before they even believe that they're going to maybe get the best value, because there is this kind of turbulence and uncertainty, and they're willing to pull that trigger if they get something that they deem that permission to buy, whether that's cash back or free shipping or something. I think the other thing is really what we're seeing is a real kind of democratization of where consumers are buying their brands, because there's more brand direct activity happening, whether that's in the consumer electronics sphere or in department stores. You see a lot of brands directly elevating their promotions beyond potentially what those traditional retailers are doing or are able to do, and are then pulling a lot of the shopper behavior their way during a particularly value-conscious time. So both of those points, I think, really yield retailers needing to think about what are their levers that they can generate in order to provide the value that the consumers are looking for.
Clearly, you have an engaged audience that is out there self-buying. As you look to next year, how do you continue to get that audience to come back all the time? Like, where are you making some of your big tech investments?
From a Rakuten standpoint, we are always just delivering the most value that we can to the shopper. We intend and live to be the most rewarding place to shop, and we partner directly with retailers and brands in order to deliver that in a way that's also economically feasible to those retailers and brands, because it's really not just about promotions or discounts. It's about those stackable events that give a consumer an ability to feel that they've won. And sometimes that doesn't mean discounts, say with luxury, for example, who, that's a dirty word, discount, of course, have started to work with tech platforms like ours in order to give that additional permission to a buyer without having to discount or use things like coupons.
I think she's inspiring me to buy my gift. Like I'm just gonna out and buy stuff today. Maybe I'm inspired.
I know. Well, we've been talking about buying for the past hour and a half.
I'm just gonna buy something. All right. Well, Julie.
Power of suggestion.
True. Julie Van Allen, Chief Revenue Officer at Rakuten Rewards. Good to see you. Happy holidays.
You as well. Thank you.
All right. Coming up, we're talking to Bilt Rewards CEO Anchor Jane. Stick with us. Taking a look at the state of the housing market, this week's Case-Shiller National Home Price Index showed home prices remain at record highs. And data on new home sales for October came in lower by 17% month over month. One company is offering some new tools to help first-time home buyers. Fintech startup Bilt Rewards wants to reward consumers for purchasing a home in this market. You may remember its partnership with Wells Fargo, launched in 2022, that allowed users to pay their rent via credit card. The company now has a valuation of about $3.25 billion after closing its latest funding round earlier this year. Let's bring in Anchor Jane, Bilt founder and CEO, for more. Anchor, good to see you here. Take us through some of the activity you're seeing on the platform. So many different dynamics happening in the housing market. Price is still high. A lot of folks still having trouble finding their first home. What are you seeing right now?
Yeah, it's fascinating, Brian. So just to give you a quick step back, as you know, so Built is the payments and rewards platform today for over 70% of the top 100 rental companies in the country. And so we see all payment volume for rent today, whether it's done by check, ACH, debit, credit. And what's interesting is, I mean, first of all, rent price growth has slowed. So that is a somewhat positive sign for renters looking for a place today, although the prices themselves still are at record highs. And so what we have been looking at is how do you now help people go from renting to home ownership, given that, look, interest rates are at least seeming to be flat for now and potentially coming down a little bit. And this starts to open up that conversation of, okay, what does it look like for me to buy my first home? And can we get that surge back in the market?
So how does what you do help them get to that level?
So it's interesting, right? The first step is actually knowing what you can afford. And if you've looked at the home search tools today, it's quite complicated. I mean, you go from paying, say, $2,500, $3,000 a month in rent, and then you look at home listings and it's $500,000, $600,000. And the question is, what does that mean for me and what I can afford? And so we worked with Fannie, Freddie, FHA, the different home groups, and we created the first all-in search tool where you just say, I can afford this much a month all in, and we will do the calculations for you automatically, looking at mortgage rates you qualify for, interest payments, taxes in the local city, insurance costs, and then show you homes that you are qualified to buy today based on an all-in monthly price. And then in the spirit of kind of Built, when you're ready to buy, we've now launched the first program that actually rewards you on that home purchase as well. So for the first time when you buy a home, you'll now get 1 point for every $2, right? So that's 1 airline mile, 1 hotel point for every $2, uncapped. So a $500,000 home now gets you 250,000 points. So right when you close, you now even have enough, instead of being down on spending power, you actually have points to help you take your family and travel around the world or invest in something else.
Anchor, what could the incoming Trump administration do to make it easier to own a home in this country?
I mean, look, obviously there's interest rates are the single biggest driver right now of affordability for these customers, as well as the down payment. And so finding more ways to give people down payment assistance, I think, is a huge thing. One of the things our search tool does is it actually automatically searches for first-time homebuyer programs that you might be eligible for. And I think a lot of folks don't know that Fannie, Freddie, FHA offer programs that are something like 3%, 5% down that can help reduce that barrier to go from renting to home ownership. But I think there's a lot of opportunity there. And then, look, as interest rates change and the mortgages become, more affordable, the buying power goes up for our consumers. And so giving that, I think we'll see some of that over the next 12 months, at least from what President Trump is saying.
Ankur, I'm curious about your business and how it works. Like, what's the business model? How do you guys make money?
Such a great question. People seem to mistakenly think that Built is a credit card company. That is not what we are. So less than 15% of our members actually have a co-brand credit card. What we have built over the last few years is the largest housing payments business. So if you live at a Related apartment, a Brookfield apartment, an Avalon Bay apartment, a Greystar apartment, you are using Built to process those payments, whether you pay by debit, credit, check, or ACH. And so just like the many multi-billion-dollar companies in payments before us, Built has now won the largest market share in housing payments. And we've done that by actually rewarding customers by giving part of that margin back. And now as we grow, we've launched our neighborhood benefits program, which helps connect local residents at apartment and condo buildings with local restaurants, grocery stores, coffee shops, fitness studios. And so merchants are now able to tap into local customers and reward them through Built for choosing to spend locally. And obviously, we take a piece of that as well.
All right, Ankur, thank you so much. Appreciate it. Ankur Jain is CEO and founder of Built Rewards.
Nice to see you. Thanks, guys.
Thanks. Coming up, we'll check in on the Thanksgiving weekend box office. Moana 2 taking theaters by storm. That's next on Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Film studios and theater chains set to win big this Thanksgiving weekend as Disney's animated film Moana 2 set to deliver the biggest Thanksgiving opening for a new film ever. And that isn't all. Moana, along with Wicked and Gladiator 2, are expected to join forces to create the biggest Thanksgiving weekend box office ever altogether. Glicked. Do you know that's what they're calling it?
No.
Glicked. It's like Barbenheimer when people, these two movies seem to be maybe a better pairing than
How did Gladiator come out over 20 years ago? How is that possible? It just feels like yesterday. I was watching Russell Crowe slay.
Did you
I
actually?
saw parts of it. I saw bits and pieces of it. I'm not going to sit here and blow smoke and then I saw this whole movie. No, I didn't see it. But I am going to see on December 20th Mufasa, The Lion King, really channeling my nostalgia and love for The Lion King. I love The Lion King. I'm a huge Lion King guy.
Oh, I didn't know you were a huge
love Lion King.
guy. Wow.
When I saw this trailer hit, I'm like, I need to see Mufasa.
Now, I really liked Moana 1, but I don't know that I'm going to see Moana 2 in the theater. I might wait for it to hit my Disney Plus. But if you look at the numbers that Moana has, of course I have Disney Plus. If you look at, he makes a note of it on his little paper. If you look at the numbers that Moana 2 has done, $13.8 million in preview screenings on Tuesday. So that is the highest ever on that day for Disney and really has dwarfed some of the other ones. Inside Out 2 was $13 million. So it's expected to do big numbers here. It looks like $135 to $145 million over the first 5 days.
Yeah, and this is all very important because if you go to our platform, type in DIS, of course, that is the Disney ticker price. Disney shares are up 22% in the past month. And we've been talking to Disney CFO Hugh Johnson the past couple quarters, and he said, guys, look at this content slate we have coming. You take that content slate, bolt it on the fact that this company has cut billions in dollars of costs out of its model, and suddenly you have a lot more profitable Disney. And it really might be a much more profitable Disney next year or in 2025 than maybe Wall Street expects.
Gladiator, by the way, Paramount.
Paramount.
But people won't indefinitely have an opportunity to invest in that one, right? Because it's going private. So that, but if you're tracking who's making what.
Do you have a big holiday? Any weekend holiday plans? Black Friday? Pulling the trigger or anything?
I don't know yet.
Yeah.
I'm not sure. We were talking about doing some volunteering this weekend.
Oh, that's very nice.
Yeah.
Yeah, that's good.
But we got to figure out.
Well, hey,
What about you?
You know where I work, and I'm taking gifts. You know where I sit, too. Julie Hyman, you're the best. All right, coming up, stay with Yahoo Finance for full coverage on the most important market trades impacting your portfolio. Have a wonderful weekend. Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This is the podcast that will make you a smarter investor and a more well-rounded investor. Really excited about our next topic here. It is all things humanoid robots and what that future may look like. Let's bring in Rob Garlick, Head of Innovation, Technology, and Future of Work at Citi Global Insights, and his partner on this really interesting latest piece of research, Wenyan Fei, over at Citi Global Insights as well, where he's an analyst. Good to see you both. Really enjoyed this piece of research. Rob, let me start with you here. And you guys come out of the gate blasting with this. Robots are no longer confined to sci-fi. Walk us through this.
Well, look, it's been a bit of a journey, truthfully. I mean, robots are hardly new, but there's a number of new developments that are happening. Artificial intelligence, probably the most important. And in 2022, we did a report on large language models and all the innovation happening in AI. We kind of thought about, well, what's next? And we did last year a report on AI agents. And then people keep saying to us, what's next? And so we lifted the cover on robots and found there is so much activity and so much innovation and development that's taking place. And, you know, the humanoid, well, we did 2 reports on robots, candidly. One was on kind of lots of different moving robots, which we can talk about. And then we did a follow-on on humanoids. And on the humanoids, we started to think, okay, well, how many players are out there? And we found there are over 50 different humanoids in development. So when I say this has gone from, you know, sci-fi to development and about to kind of launch into something very big, we're just basically reporting what we were seeing. And then what we did in the report was we tried to sort of dimension it and say, how big could this get? Which I'm sure we'll get into in this conversation.
Yeah, important point there real quick to the Yahoo Finance community. There are more people involved in this space than Tesla CEO Elon Musk making humanoid robots. Very important point by Rob there. Wenyan, let me go to you. How big, before we get into some of the companies trying to change the game here and what these robots do and what they don't do, how big of a market opportunity is humanoid robots looking out over the next few decades?
So basically, we build a model to set the market because we heard different market sizing for humanoids. Some are really big and some are really small, but we want to get to our own proprietary model. So we model 7 different use cases for humanoids based on the market that we think are going to be the biggest in the future. So we modeled home services like those robots doing the laundry, mowing the lawn, and we sized the industry market whereby the humanoid robots working in factories and warehouses. And we also do construction, parcel delivery, food and grocery delivery, supermarkets, hotels, like basically every big market that we included. And the number that we got to is 30 million in unit number by 2035 and 650 roughly by 2050 is the number that we got to in terms of units. And if you multiply by the pricing point that we are currently looking at is around 20 to 30K US dollars, and we are expecting it to gradually goes down a little bit in the future, but I think by 2050, we are looking at a $7 trillion market for humanoid.
Rob, robots that can mow your lawn? What are we talking about here? A human-looking robot that is actually pushing a lawnmower? Like, how far away are we from that?
Well, look, the penetration of cleaning robots in the home in the US is already 20%. Okay, these like robots that go around and vacuum or mop your floor.
Oh, I love my Roomba. Big Roomba fan.
Yeah, there you go. And look, there are multiple different varieties of those. I mean, one video kind of samples 94 different versions of that. So it's not that you necessarily need a humanoid to try and change that, or a humanoid to substitute for your robot lawnmower that you might already have or not. So you've got to be careful around the fact that just because a humanoid can do something doesn't mean that they should do something. But there are plenty of things that we think that they can do that are going to be useful for you. And so, for example, I mean, actually just a very live example, a friend of mine is just visiting his mother, who is really having, she's in her 80s, she's having some real difficulty. He can't be there very much of the time. He lives abroad and travels abroad a lot. And, you know, to be able to have something, a robot that will be able to help lift things, lift her, for example, you know, would be extremely useful. So you've got to be careful around just because something can do so doesn't mean it's the right thing to do so. But at the same time, one of the things that is interesting about humanoids, when people say, well, why should we even have them, is that our man-made world that we've built, whether it is our homes or our factories or our shop floors or everything else, are built for humans. And so fitting humanoids into that without needing more infrastructure is a relatively easy thing to do. And also their versatility to be able to do things for you can also be really useful as well.
Rob, now you have me thinking, like, you know, at some point, I may have to care for my aging parents. And it's something I've never done before, but maybe I just program this humanoid and let them take care of them. We're at the point where these robots could actually lift humans, and what does the AI look like here?
Well, the AI is a really important facet because, as I said, robots have been around for years, and we went from industrial robots to cobots, you know, and things behind cages to things were whizzing around factory floors or warehouses, whatever else it might be. But in terms of making them useful for lots of different noisy environments, you know, AI has now developed to a point where actually we can have a conversation using natural language processing previously and now large language models and foundation models to be able to have a two-way conversation. You can take that and put it into coding to be able to codify the actions that you want them to be able to do. They obviously are able to see, and I think it's pretty remarkable, just as an example, and you take a step back. We wrote our first Car of the Future report in 2014, thinking about autonomous driverless vehicles. And yes, it's a long time coming for different reasons like safety and regulation, etc. But the reality is you can now have moving robots going at 70 miles an hour around the streets in certain places. So it's not too much of a leap to think, well, if you can move from there to be able to move to, you know, less noisy, easier to navigate environments, that they can be very useful. But this AI component is really critical. And one of the things people talk about in AI is now we have the ability to have multimodal AI. So rather than just discrete units of this is great at vision, this is great at language, etc., this is great at coding actions, you're able to then bring them all together. And that's what turns them from, quite frankly, being potentially more useless to being more useful.
Wenyan, your $7 trillion market potential note by 2050, what are some of the challenges to reaching that? I imagine manufacturing robots on this scale might be one of them.
Yeah, exactly. I think one of the challenges is that like we don't have the scale of production right now. A lot of those parts for those humanoids, for those humanoid producers, they're just 3D printing all of the parts. I think one of the hindrance would be we need to build the production line for that, and also the way that I like to think about this is that AI is the brain of humanoids, and then we need to train the AI in the real world in order for them to learn how to perform specific tasks. And in order to train them, we want to have the data for them, but we are running out of data. Data is really important. I think a lot of so one of the infrastructure that you can invest in is data centers, because it really powers the training of AI. So data would be one of the barriers, and now is currently roughly 20% of human efficiency, and it still continue to learn. It developed really fast, but we need some time in order to get to a world where the efficiency of humanoid is like 100% or 200% of human to reach that substitution ratio of 1:1 to 2:1.
You mentioned, Wenyan, in the report that one of the biggest opportunities for humanoids is, well, I'll list them here. It's home services, industrials are key, delivery. Why home services? Like, what do you think a humanoid will end up doing?
I think the biggest area for is really home services, is because we've got a huge number, 3 billion households in the world, and based on the survey that we saw, 70% of the homes in the world they're potentially willing to adopt but obviously there are differences by development in different areas. So we segment the geography into more developed areas, less developed areas, and least developed areas, and we apply a very conservative number for the. Even though we apply a very conservative number, we still get a very huge unit number. So what they can do is they can do a lot of things. You've already got the robot cleaner in your home mopping your floor, and they can do the laundries, they can make you a cup of tea, they can mowing the lawns, and they can take care of the elderly people that you don't need to send your grandparents or parents to the care home. You can just take care of them at home. I think this is one of the biggest use cases, actually.
That's just wild. I just program my robot. They can take care of my mom or dad. They can just serve them food. They can call them. Maybe because I don't have to call them. Maybe they can even do that. You know, Rob, before we go to break, part of your title is Future of Work. And as I'm listening to hearing you speak, I have to imagine these humanoids are going to change how work is done in a big way. Like I might be sitting here with my arm around like Ryan Sazi, the robot, and maybe we're having a four-way discussion. I mean, what impact do you think this will have on the U.S. labor force, if not the world labor force?
So the answer could be very significant. And one of the things that was a real surprise to us, even though this is pretty simple maths, Brian, is the payback period for these humanoids could be very, very short indeed. So one of the things we do, I mean, you mentioned Musk and Tesla's Optimus. You know, there's a different price band for that between $20,000 and $30,000. But let's call it 25 for argument's sake. But you take that and you say how many hours a day and then a week can it work? Put it on US minimum wages, the lowest of which is $7.25, and we get to a 36-week payback period. So the economic opportunity of this could be enormous and massive cost savings for businesses that use it. So you and Wenyan just discussed home services, and that potentially could be the biggest market. But the first market will be in industrial settings because there is an economic substitution potentially that can go with those very attractive payback periods and the fact that robots, don't take sick leave and don't take holidays and all that type of stuff. Now, back to your question on the future of work and what it means. I mean, it's not clear the substitution rate that you should use. We had an assumption of a 1-for-1 substitution. But let's say these robots are working 23 hours a day, which is possible. Should you use a 3-for-1 substitution rather than a 1-for-1? And taking tractors as an example, because, we look back in history and you can see the fact that, the tractor didn't just substitute for one aggregate worker or one horse. I mean, in fact, the biggest tractor these days has a 760 horsepower. Okay, so in theory, they're substituting for a lot. There's also some fantastic work previously. We've seen that in robots, industrial robots, and the substitution rate for those was about 3.3 for each robot substituted for 3.3 people. Mm-hmm. So anyway, you start multiplying this stuff and it could be quite significant. But final thing is, it doesn't just need to be substitution. I mean, this is obviously augmentation as well. So your parents might not be, this is substituting your time rather than substituting you. And so they basically get an extra service to help them potentially stay in their homes and be freer for longer.
Yeah, I don't think they want to see me. All right, well, guys, hang with me. We're going to go off for a quick break. We'll be right back here on Opening Bid. All right, welcome back to Opening Bid. Talking to Rob Garlick and Wenyan Fei over at Citi Global Insights. Really fascinating work on humanoids, the future of humanoids, how I may have one to take care of my aging parents, how they might make less minimum wage. I mean, this is, what else more can you ask for from a robot? But let's talk some names, gents. Let's start with the name that is top of mind on the Yahoo Finance platform. That's Tesla, Elon Musk. It's Optimus robot. What do you think about this robot? How many do you think they could produce, Wenyan? And do you see them as the market leader at this point?
Well, I think in terms of making the noise, making the headlines in the market, definitely, I think they are sort of perceived as the leader. But as we identify, there are like 50, 60 different players in the market, and they are all making progress towards production. But just in terms of like, because these things, like to put them into production is quite expensive, especially if you want to build the production line for them in terms of the capital that they are available to deploy. I think maybe Tesla Optimus is definitely one of the leaders for the market. And I think like in recent launch event, you see those videos of those Optimus robots doing the butler and entertaining people. They're already quite intelligent. I feel like well, they've already got the prototype, but they need to put them into mass production. In terms, well, I think Elon Musk was talking about several thousand to be in its gigafactory starting from 2025, and then maybe ultimately the substitution rate would be like even higher for factory settings to replace those factory workers within the Tesla factory.
Do you think Musk is correct when he says that we may own one of these Tesla robots? Like they will be of some form of assistant to us long before not. And then secondarily, how complicated is it to make an Optimus robot? You know, I'm trying to think, can he pump out millions of these each year at the same time they're trying to also make cars that drive by themselves?
Well, I think it's really depending on the demand of those humanoid robots. Although they are very good, and I'm totally convinced that they can make you a cup of tea, doing the laundries, mopping the floor, and taking care of your parents at home. I'm totally convinced. But the problem is that they're not very cheap. Like I think originally he was talking about 20,000, but now he is inflating the price to 25, 30,000. So the cost of these things are really a barrier for the people to, like, you certainly want one assistant in your home, but like if it's 25, 30,000, then probably you might think twice about that. I think the price is one of the issue that they need to solve. But I totally, if there's a demand, if they can drive the price down. Firstly, would be the rich people buying it, and then if they can drive the price down, then seeing more demand, maybe they can produce mailings definitely in the future, but not right now.
Rob, interestingly, you guys correctly put out in this report, like literally the faces of these robots, the specs on what they do. As you were doing this research, what other companies in this space really impressed you, and what are they doing that led you to be impressed?
So yeah, the surprise was there's so many, and then when you start picking different bits, who is good at speed, who is good at carrying, who is good at vision, who is the degrees of freedom. I mean, there's a great variant, to be honest with you. I think one of the surprises is how developed this is in China. And there are leading companies in China, such as Unitree, which are already out on the market at essentially $14,000. So, you're talking with Wenyan there about, Tesla. And by the way, we're looking at long-term thematics. We're not talking about stock recommendations. It's not what we do. But, the Tesla Optimus and even Figure AI and those things, they're not yet out, and they're not yet commercial, and they haven't yet been proven. And I think one of the things, just to make sure, caveat all of your listeners on this, is that, when we're modeling out, although we get to 648 million by 2050, we only get to 13 million by 2035. So, we were trying to make sure we are sensible in the same way that autonomous vehicles got talked about, a decade ago. And it's only now that the inflection up is happening post the the approval in San Francisco and Waymo doing 100,000 rides per week. So but however, when I say that, the development is taking place at a rapid pace in China. And if you look at the patents, for example, then China dominates this space. If you look at the production scale that they potentially have, if you look at the costs that are already there. So I think one of the conclusions is this is certainly not just a US story. This is going to be a story that happens in several different geographies.
Rob, aren't there two powerful trends underlying this move to humanoids? I'm looking at some of my notes here. I mean, we have slowing population growth around the world. We have an aging population growth around the world as well.
Yeah, and actually, there's another one I would put in there, which is obviously there's a shortage in certain labor areas. I mean, getting carers is not always easy. Getting carers that stay with people is not always easy. And so, when you look at shortages of staff, that's an obvious reason why there's a demand to plug in humanoids and other robots in other forms. The aging demographics is clearly an issue. And actually what we modeled in terms of people getting older and the needs for people, say, for example, in the care industry, the demands will be very substantial. So, and, we came out, I mean, we haven't talked about it yet, but we came out actually very positive on the fact that these things can be, a chauffeur, a butler, a carer for people. And I think most people would sign up to have that type of service provided to them.
In the last 3 minutes of the show, guys, we always like to get our hot takes from our guests. Since I have two of you here, I will come to each of you on a different one. Wenyan, let me go to you for a hot take. What did you think about Sophia the robot?
I think it's quite interesting that they can do the thing they can do right now. But I just want to add a sentence in terms of hot take to our $7 trillion market size, is that if you look at the global GDP is above 100 trillion, and if you look at it at the 2050 is above 200 trillion, and then we're talking about the potential of these humanoid robots substituting 30-40% of the workforce. So it's definitely going to be huge. 7 trillion is not a big number compared to this, and we are also capturing the unvalued domestic workforce that is not included in the GDP. So 7 trillion is actually that doesn't sound that big if you can compare to these numbers.
Rob, over to you for a hot take. Do you see these humanoids entering the military?
Well, we didn't model a number of different areas, going into safety areas like fires and stuff like that. Security could be a big one, and then military as well. And we didn't model them because, candidly, it's quite difficult to get to those numbers. And I think that's a whole nother report at a potential another time. But I do think if you take the opportunity set, you're already seeing things like robo-dogs going into the front line. And some of these robo-dogs who can carry gear, they cost like $7,000. I mean, not necessarily expensive, and they're saving lives and doing great things. But then you take that to, can humanoids say the same things? The answer is, I think it's something that should be discussed in society about whether this is the right thing to do or not. The EU AI Act does a lot, but it doesn't include military.
I mean, the robo-dog seems safe. I mean, nothing like a pooch coming, going into battle, carrying some gear. I mean, that makes sense. I don't know about a humanoid, packing some heat, but I mean, hard to argue with a humanoid Fido. It makes sense to me. How'd you guys get on this beat in the minute that we have left? How'd you guys start covering this stuff?
Well, we got lucky, being able to look at lots of areas of innovation. Artificial intelligence, obviously huge. We were writing about that, writing about agents, writing about quantum computing. And we got the opportunity to look at robots. And when we peeled back the cover, we found out there was just more and more. And so the innovation taking place in this space is very significant. And I think it can be a really big opportunity for society and people. But at the same time, there are a number of downsides, whether you want to talk about military, want to talk about the future of work. And we need to make sure that those conversations are being had.
Among the many things I learned from both of you in this chat, one, my aging parents are going to be taken care of by robots. Sounds more cost effective to me and just frankly easier in my life. And then I think the world needs a robo-dog. Really fascinating here, analysis from you guys. Looking forward to continuing to follow your work on this category. Rob Garlick and Wenyan Fei from Citi Global Insights. We'll talk to you soon.
Thank you.
All right, and that's it.
Thank you for having us.
Of course. That's it for the latest episode of Opening Bid. Hit us with those 5 stars on Spotify, likes or thumbs up on YouTube, and keep on showing us that love on Apple Music. We feel it. We feel that appreciation. It keeps us going for many, many more episodes to come. We'll talk to you soon.
Welcome to Stocks in Translation. I'm Jerry Blickery, your host, along with the People's Voice, Sydney Freed. Thank you for joining and tuning in. First, some housekeeping notes. Be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Steve Stosnick, Chief Strategist at Interactive Brokers. Steve, thank you for coming back here today. And it is a big day. We're going to be talking about how the markets are digesting election results. Full disclosure, we are taping this Wednesday, the day after the election. So we know the next president, the Republicans took the Senate, and we know the House is still up for grabs, but we don't know what the Fed is doing. And our word of the day, it is risk. Thought we'd go a little broad on a risk on day. This episode is brought to you by the number 3.79%. That is where the bond market sees the Fed's benchmark rate at the end of 2025. Why rates are heading higher. That's right, higher. So Steve, big markets day here, big everything day. What's your first blush take on everything?
Well, Jared, first of all, thank you for having me, and good to see you, Sydney. I think today what we're seeing is really this, that you mentioned it is a risk-on day. Now, we've been risk-on for the better part of 2 years, when you really think about it, but we've removed the uncertainty as to who the president will be. We now know who that is. I don't know that we have policy certainty, but we have a better sense of the direction that we're going to take. Markets weren't particularly perturbed with either candidate. It's not as though markets performed very poorly under the Biden administration. We're obviously coming into this off a very solid run with that as well. But markets see the possibility for lower tax rates under the Trump administration. That's catnip to investors. They always want lower tax rates. The fly in the ointment, however, is that's not necessarily good news to a bond investor's ears. And that's going to be the push-pull as we go forward is, on a day like today, where you could argue that some of the fact that rates are higher, as we're taping this, sort of between 10 and 20 basis points, between 2s and 30s, some of that might be the risk-off mentality. Some of it might be risk-on mentality, I should say. Well, some of it might be the bond market perceiving risks off, whereas the stock market is risk on. So you could get a real push-pull there.
All right, so there's a lot of nuance in there, and we're going to pull it all apart. And I think this is a perfect time to introduce our phrase of the day or word of the day, risk. So here we go. Risk is a chance that an investment's actual return will differ from the expected return, potentially resulting in financial loss. So we try to quantify it. We try to manage it. We never really escape its reach. So within the context of this, and it's very broad, what does risk mean to you?
Risk, well, that pretty much sums it up. Risk is the sense that things will not go your way all the time. I think what happens is, and a lot of investors focus on reward. There's always this sort of, in theory, there's sort of the yin and the yang of the investment world. There's risk versus reward, but I think a lot of times people get very focused on reward without much of an idea of what risk might be. And I think when you get into an environment where things are a little frothy, people lose sight of that. I think about some of the days where, when the market's down, call it 1.5%, and I get freaked out phone calls. Why is the market down? Why is the market down?
Because it hasn't been down 2%, in a long time.
Exactly. But it's sort of, the idea is markets are supposed to go up. They do go up over time. But I think we get focused on the reward and not on the risk. And risk is always out there. And risk has a nasty way of biting you at exactly the wrong time.
So, Steve, we just talked about how markets have been on the up and up for a while now. What is the biggest risk you see heading into 2025?
Well, there's policy uncertainty. Will the tax policies, will sort of the protectionist policies have negative effects on stocks and on the economy? Might they have inflationary impact? The litmus test for that does come through the bond market. And so I think if you continue to see bond yields lifting, that could be a headwind for stocks.
What about the potential for, we're going to hit the debt ceiling pretty soon. We could have to shut down the government as well. So we got two issues there, and we don't know who controls the House. So it seems that there's going to be some policy uncertainty for a little bit of time there. How important is that, that these things get resolved quickly? In other words, the debt ceiling and the debt limit.
The debt ceiling and the debt limit's a weird thing. I mean, I think we're the only country that actually has this. I think Denmark is the only other country, but Denmark, they just rubber stamp it all the time. And that used to be the case here. Now, like everything else, it's become politicized. I think it's one of those things investors don't react to until it's like really staring them in the face, because it's usually there's brinksmanship that gets resolved at the last minute. Nobody really wants.
Always gets resolved.
Well, we're still here.
Exactly, we're still here. But you have had situations where it took a while for it to get resolved. But usually it gets resolved like at the last minute. It's sort of like, like a high school student turning in their homework at the last minute. Eventually.
The risk is that every once in a while they get caught.
Yeah.
Exactly.
So
there you go.
Turning a bit back to the markets, we're seeing really big moves in the Russell 2000 small caps today, almost at a record. But we have high rates too. And we've talked to a lot of guests who've said that small caps don't really like higher rates. So kind of what's going on there?
Small caps don't like higher rates because many of them are, many of the stocks in the Russell 2000 are money-losing stocks, which means they have to be able to borrow money to stay afloat, which means they prefer lower rates. All borrowers prefer lower rates. And so at this point, we're a very debt-heavy economy, but those stocks, in many cases, really need debt as a lifeline. But in the short term, the idea that, number one, protectionism probably helps these companies more than most. Microsoft doesn't need a lot of protectionism, right? I mean, Alphabet, these companies are fine.
They got their moats.
They have these big moats and they're fine within them. Company number 327 in the Russell 2000, and I have no idea what it is. I just picked a number sort of at random.
Yes.
You know, that company probably does not have a very big competitive moat. And so odds are some sort of protectionist policies, America First type of policy, would help that company. Second thing is we may get a change at the FTC, almost definitely get a change at the FTC. The current chair, Lena Khan, has been fairly strident about putting the kibosh on mergers that she and her commission view as anti-competitive. It's probably fair to think that whoever would replace her would be a bit more lax about that sort of thing. It's part of the whole deregulatory ethos, I think, that we have. And so small cap stocks are more likely to get taken over. Again, nobody's taking over Microsoft, but somebody might take over that number 327 company, if its prospects are good.
We've seen the November to December timeframe just explode in stocks very consistently recently. And we're just talking, you can go back in the presidential elections, but even to November 2023, November 2022. And I had a question, how does seasonality affect your analysis? Because a lot of people were expecting this election to kind of unleash this wave of CapEx. It was something I was writing about in Morning Brief. And in the US presidential cycle, predictably, after the election, you get this wave of investment. How much does this play in your analysis?
Not too much. It's out there. I keep an eye on it, but seasonality has a way of working until it doesn't work. And
it's been good recently.
It hasn't. So September, for example, I did the work on this, and I think, what was it, like 4 out of the prior 5 Septembers had been negative coming into this year. September was gangbusters good. And as it turns out, over the 10-year period, though, it was like 50-50 as to whether it was going to go up or down. November has had a great track record because October and September tend to be 2 of the worst months. But September was a great month and October was a down month, but only slightly. So literally not until the last day of October did the S&P flip into negative territory. So seasonality, I think, is less important right now than momentum. We definitely have one giant momentum trade, and you talk about it all the time on air, and you notice, you recognize it. You're a technician at heart. The trend is your friend, and this trend has been extraordinarily powerful. And investors and traders alike have been, have been riding it basically.
How do you think about your own investment thesis when seasonality doesn't kind of line up with what we expect?
That's kind of why I take into account seasonality, but I don't trade off it.
I think you have to kind of trade off it consistently. Like if you don't take the signals consistently, you miss out.
But even when I've looked for some consistency, and I don't have I can't spout the link off, but I did put a link up on our website, IBKR Campus. I'll throw in that little
yeah, we'll put it up on.
Yeah, and I'll send you the link and we can put it in. But I did do some work on it, and the seasonality, it's too inconsistent to be really tradable. So I think it's part of investor psychology. Of course, we've all heard the phrase "sell in May and go away," but we never really know what are we selling and where are we going necessarily. But and certainly, and the flip side of that would be then the November to May period tends to be the best, which you can document over time, but it's not perfect, and certainly on a month-over-month basis, it's a little too random to really, I think, make too many heavy-duty decisions.
We'll leave seasonality there.
Yeah. What do you think about the VIX? We're seeing it tank today.
Well, you just removed a big amount of uncertainty, didn't you? The VIX. We all look at the VIX itself, which again, let me.
You can't trade it, by the way.
You cannot trade VIX direct,
which is confusing to me. But anyway, keep going.
It is an index. Well, you can't trade SPX either, but there are futures that trade on it and ETFs that trade on it. And that's the case with VIX. There are VIX futures and there are VIX-linked ETFs. So that is how you trade it. But one of my going phrases is, and I probably have used it with you before, is VIX is not a fear gauge. It just plays one on TV.
We spent some time on that.
I know.
On the previous
I know we discussed that before. So I'm going to bring it up again. And what it's telling us is, remember, it's the market's best estimate of volatility over the coming 30 days. And you had an election, and VIX tends to decline once a big event is behind it. So the election's not a factor in volatility anymore.
Imagine what happens after the Fed.
Well, I was going to say, what about the Fed meeting? It's not really a factor there
Well,
for
can
tomorrow?
we just pause right there, and we'll talk about the Fed after this break? Because coming up, we're going to take on Jay Powell and the Fed's rate path. And on a who wore better, it's NVIDIA versus Intel, but we're going to do some time travel as well. All right, we are back. This episode is brought to you by the number 3.79%. Now, that is where investors think the Fed will lower rates to by December 2025, next year. So the important thing to know is that this terminal rate is up almost a full percentage point higher than where it was when the Fed first cut in September, and that wasn't that long ago. So markets are seeing fewer and fewer Fed rate cuts, Steve. And what are you making of this?
Well, I think in general, the Fed funds crowd has been ahead of the Fed pretty consistently. Remember, think back to January when we were discussing how are we going to get 7 or 8 rate cuts in this environment.
Didn't seem plausible.
Guess what? It wasn't.
Yes.
We've gotten 2, and at most we're going to get 4. And I'll assert here that we'll probably get the 3rd tomorrow. Again, we're taping this the day before the FOMC meeting. The Fed is not big on surprising markets, so I think they'll probably just go through with it. But it's not clear it's not clear that we're going to get the December rate cut, and certainly it's not clear what we get in terms of 2025. And again, the bond market's telling us that things might be going the wrong way in terms of inflation and indebtedness and things of that nature for the Fed to really go gangbusters in cutting rates. Bottom line is, I'm going to ask this sort of as a hypothetical. I've been of the camp of, what do we really need it for? When you think about what
more rate cuts?
More rate cuts,
Yeah.
right? I mean, okay, so the Fed's dual mandate is stable prices and full employment. Well, yes, we've seen disinflation, but the inflation rate has sort of flirted with the 2% target, but we seem to be sort of finding our level there. And I would argue we have something similar to disinflation in the labor market. It's been slowing down, but it hasn't really slowed down. It hasn't tipped over. So 4.1% unemployment rate still means that essentially 96% of the people who want a job have one. That's a historically enviable employment rate. Plus, you've had average hourly earnings in the 0.3, 0.4% range month over month, which is actually above CPI, which is good if you're the average worker. And of course, none of us really, I don't know who that is, but in general, when you have wages in general going up faster than CPI, that's a good thing. And you have credit spreads, the amount that when companies borrow money based on their credit, they pay a spread over treasuries, because assuming the treasury can print money.
They're not paying that much more right now.
That spread is almost at record lows. And the stock market is hardly suffering from a lack of liquidity. And you're certainly seeing speculative investments, going gangbusters. I mean, look at Bitcoin,
Bitcoin,
stock, et cetera. So why exactly do we need aggressive rate cuts? It's not clear to me why.
It's not clear to me why, but are you concerned with this potential reacceleration in inflation?
Yeah, or the no landing, basically, if we're going to talk landing.
It's possible because, I think that this election may have raised that specter a bit, because tariffs are potentially inflationary. If they're going to go ahead and deport millions of workers, that's inflationary. There are certainly reasons to think that inflation that we may. I'm not going to go out and say that we're seeing a real acceleration in inflation right now, but the potential exists that it's possible we may have gotten what we're going to get on the inflationary front in the short term. A lot of that depends on the new administration's policies.
Anything the Fed needs to watch out for maybe next year, new administration, just not necessarily even in the administration, but things in the economy that they might need to deal with that they haven't had to deal with before?
Well, I mean, to some extent, they had to deal with some of it 4 years ago. But I think, again, if you're getting into a situation where there's protectionism, one of the things of globalization means that it's allowed. You go to Walmart, you buy from Amazon, or Temu, if that's your cup of tea. Those are sort of, they've been sort of disinflationary elements for years because they've been able to source stuff globally, much of it from China, but source it globally where it can be made more cheaply. If that reverses and it's made in America, there are certainly. I understand the appeal of a made in America policy, and I'm not gonna go down that political road. But from an economic point of view, if you're forcing consumers to buy something that's made potentially in a higher cost jurisdiction, that does not help inflation.
I mean, these are long-term secular trends that we're talking about. Maybe structural inflation that's higher. That we'd have any other long-term trends you're thinking about that might be applicable here, because we get caught up in the day-to-day, what's going to happen in the next 3 months, 6 months, whatever, but long-term trends.
The long-term trend that's been driving the stock market has been the love affair that we have with AI.
And we haven't talked about that much.
I was waiting for it.
As
you started your sentence, I was like, he's going to say AI.
All right, we need funfetti when we have a word, some kind of trigger here, but yeah.
Like the secret, so you have the secret word, and
Definitely.
but at some point, and we started to see it a little bit this earnings season, the investors are kind of wondering, okay, all these billions of dollars are being spent. Again, there's the old analogy that in a gold rush, you should buy the people who manufacture the picks and shovels.
Yeah.
Well, the semiconductor manufacturers are the picks and the shovels. To some extent, then you have, I guess, the big mining companies. Whether it's Microsoft, whether it's Google, whether it's Alphabet, the same company, or Meta, I should say. They've been spending billions on AI. It's not clear that there's much of a return there, and even more murky is what the benefit of AI is for the average everyday company.
I think B of A just crunched the numbers, and I was actually just writing about this, so I happen to remember some of this, but they crunched the numbers and they realized that these big CapEx investment cycles, the companies who invested in them don't tend to perform that well in the stock market in the years afterwards. So it gets back to your pick and shovels argument. Maybe it's not going to be these hyperscalers here.
Or maybe it's just really, really long-term play. We got to wait another decade or so.
Figure
to
out
see the payoff.
monetization in 2031.
Exactly.
Well, that's the internet. Think about it. That was what happened with the internet.
Took a while to figure out.
Cisco, Intel were the big companies in the internet era. And it took a while. The internet did actually revolutionize business. It just didn't do it immediately.
This is a perfect segue here, because guess what? We're going to do a time warp on who wore it better today. First, let's travel back to 1999 when Intel was the tech darling that got the big invite to the Dow Jones ball. It was the height of the dot-com era, and Intel's processors were ubiquitous. They were everywhere. Now, fast forward to 2024. We've got another chip darling, minting money for Jensen Huang and the NVIDIA shareholders. Of course, that would be NVIDIA. The very nuanced question here, Steve, is who's wearing this Dow nod better? Which endorsement speaks more strongly of the company in the spirit of the times? Was it Intel and the dot-com boom, or is it today NVIDIA? And we don't have the benefit of history that way we do with Intel, but
I think the analog is tremendous. I don't know we won't know who wore it better.
It raises good questions.
But it does raise good questions. And bear in mind, Intel was added, I think, in October of 1999, just in time for things, like call it 6 to 9 months before the whole cycle changed. I hate to think that the Dow committee did the same thing with NVIDIA.
The Dow committee.
Well, it's S&P Global now.
It is S&P Global now. I know that's, but it's part of my general distaste for the Dow. If you'll let me go down that.
Oh, please.
If you'll let me go down that road.
We love opinions about the Dow. It's a people's index.
It is the people's index, but I don't know which people.
Oh, wow. It's not the people's voice, it's people's index.
I like the Dow because it only has 30 stocks. Yeah. That's my hot take. It's not that hot.
And that's the problem.
Yeah.
It's 30 stocks. It's 30 relatively arbitrary stocks. It's,
it's very arbitrary. It's
why Sherwin-Williams as opposed to Dow Chemical?
Is it like America's stocks, kind of?
Yeah. It's meant to be America's stocks. It is. But remember the little history here about the Dow. Please. It was created in 1896. The original measure was the Dow Jones Utilities, but remember, what's the technology that was available to the people creating?
I don't think they had radios.
They didn't. They had a pencil and paper, and so it was an index. So it was an average because that's what you could do on the fly. You could
do it.
You could add up. You could add up exactly. You could add up 12 numbers and divide it by 12, and there's the movement. And to be fair, there wasn't really a great way to measure markets beforehand. So there it went. Mm-hmm. The problem is, as we now live in a computer age, we can measure things by market cap, where you take the stock price, multiply it by the number of shares, and then divide it.
We were doing that in the 1920s once a week with the S&P stocks.
Exactly.
But only once a week.
Once a week, and it was like I think it was originally the S&P like 100, and then 290, and then 270, and then eventually in the 50s it became the S&P 500 because they could do it, if not real time, relatively quickly with the newfangled computer technology that they had. And so is it the ideal index? Not necessarily. Here's the problem I have with the Dow and why, if I were your editor, I would banish from your air and all the other ones.
This is going to be good.
Because it's price weighted, because that's what an average is. You take the 12 prices and divide and sum them and divide them. In this case, the divisor changes because of splits and everything, so it's not 12.
But you're still adding and dividing.
You're adding and dividing, but only by the price. So therefore, the things with the biggest price have the biggest weight.
Goldman
Sachs, UNH and Goldman are number 1 and number 2. At the bottom of the list is Verizon. The which is, so Goldman has a $550-ish price, and Verizon's about, what, 37 or 40 or something of that nature. So Goldman has, call it 12 times the weight of Verizon. The market capitalization of both those companies is almost exactly the same, within a few $billion. They're both about 150 some odd $1 billion. Is there any reason why Goldman should be twice as important? And let me bring it forward. How much time do you spend talking about NVIDIA versus talking about Sherwin-Williams in your reporting?
What is this disdain for Sherwin-Williams?
I have no disdain.
These are great rhetorical questions, and I emphasize rhetorical because we have to close here. 24 minutes has by. Make sure you check out all our other episodes on our home site, mobile, and podcast platforms. Keep your dial tuned to Yahoo Finance.
Hello and welcome to Market Domination on this holiday shortened trading day. I'm Julie Hyman, Madison Mills in for Josh Lipton today, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
That's exactly right. And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings early today on Wall Street.
Younger generations, and I'm talking about even Gen Zs, they're back in the stores. They want to be where other people are. They want any excuse not to be on their devices. It's become a social activity again, and I think that's why we're seeing some uptick in the traffic in these malls.
even that if the Fed doesn't cut at the pace that is expected right now, those are all risks just for the main fact that we see markets as really priced to perfection. And that doesn't mean that, you can't see the equities continue to tick higher. We actually think that they will, because sentiment will continue to improve and go higher.
As it relates to NVIDIA, we saw a lot of retail investors chase into that after the split. They got some benefits, but at the end of the day, you have a stock that's priced for perfection, trading at some 40 times sales, 40 times forward earnings. A lot has to go right. And the problem is there was a period in time when NVIDIA, the stock price went up and it actually got cheaper because the multiple went down. That is no longer the case because profit margins have capped out.
Got an hour to go until the market close. No, you don't have your times messed up. It is indeed noon Eastern, but we've got an early close after the Thanksgiving holiday today. And we're seeing stocks get a little bit of a lift today. The Dow up almost 300 points, let's call it about 2/3 of 1%. The S&P 500 also up about 2/3 of 1%. And the Nasdaq up about 3/4 of 1%. We're looking at the end of month numbers because it's the last trading day of November. The Nasdaq has had a pretty decent run in the month here, up 6%, although it's more sideways action after the election. The S&P more upward momentum after the election. I have a feeling the Dow is the winner here, and indeed it is. It has been the biggest winner of the month.
The biggest winner, but also it's been interesting to take a look at small caps. I was just mentioning, Julie, with the Russell up nearly 1% this morning. Take a look, though, over the past 20 days. It's up about 10%.
You can
see it's been interesting to see it kind of coming off its highs from the morning here. A little bit of small cap momentum coming out of Thanksgiving dinner, I guess. But,
but it's been the monster game. I mean, we've talked to so many people over the course of this year who say they like small caps. And small caps this year,
huge year,
but not until now. Everybody's like, I like small caps, I like small caps, I like small caps. Oh, okay. And then, after the election is really where they have taken off.
And I think it's been the best month for the Russell since December of 2023 as well. So we're certainly seeing it having a massive rally into year end. It'll be interesting to see whether we get that momentum heading into the new year too.
Yes, it will. Quick check on what's going on today sector-wise as well here. As we look at the S&P 500 sectors, everything in the green actually, even energy, which is lagging, but tech and consumer discretionary doing the best here today. It's a holiday shortened day.
Right.
Volume is light, but nonetheless, we look at the numbers. And can we look at Bitcoin for
I was surprised you weren't flipping it to Bitcoin earlier, Julie.
We're going to talk about it a little bit more later in the show also, but it is pushing back up towards, that's the month for Bitcoin, which has been big, obviously. Huge. And then today, going back up towards the $100,000 level. We'll see if and when it makes it there.
If and when we get a Thanksgiving surprise. I don't think we're going to get it today, but I've been wrong before. I've been wrong before. For more on what we're seeing in the market as we get set to wrap up the week, as well as the trading month, we're going to get to Quincy Crosby, Chief Global Strategist at LPL Financial. Quincy, it's great to have you on here. So looking like a positive day when it comes to equities here. Santa coming in a little bit early for the market this November. What is going to carry that rally into the end of this year?
Well, first of all, you're going to go into probably the best month in terms of seasonality is December. November and December together tend to be good months for the market. Not always, but statistically, it looks as if we will end the year in positive territory, absent an exogenous shock or some headline that skews the market down. But probably we will be in positive territory. But what we're going to be seeing is jockeying for performance, for portfolio managers, making certain they end the end of the year in positive territory. And many of them may actually close their books earlier if the market comes in December and really hard and higher. Many of them just lock up and they don't want to jeopardize a very strong positive market. But overall, the market is still enthusiastic about the incoming administration. Granted, tariffs are a concern, but you can see where the market is beginning to suspect that maybe the higher tariffs, the headlines are a tactical move by the administration, because we're already seeing the leaks come out. We're seeing more than just leaks. We're seeing information coming out, and we're seeing the responses from our trading partners. Already, Mexico has been involved, and in addition, we're going to be hearing from Canada. Needless to say, China has actually put forth some olive branches. Some Americans who've been in custody in jail for many years have been let go. So it looks as if they are trying to ameliorate the headlines.
Quincy, you were talking about seasonality there as well, and I'm curious about sort of on an annual basis what we tend to see, because we're looking at the best year now since 2013 for the S&P 500. As you said, everybody's trying to lock in those returns on the year. Like if your money manager didn't, at least match some of these returns or at least have a positive year, you got to be asking some questions. But I'm curious about what you tend to see after a return like this going into the next year, whether you see some moderation.
Well, we probably do. I mean, for one thing, we can't forget about earnings. I mean, really, it is what underpins the market when all is said and done. And we're seeing earnings revisions coming down for 2025. That doesn't mean that, we're not going to see upward revisions, but as we speak about it now, we're looking at more downward revisions rather than revisions climbing higher. So that's going to be very important what the earnings are. And then again, it's the Fed. This market has been disappointed so many times regarding the possibility of a series of rate cuts. And if the Fed begins to suggest that we are not going to have as many rate cuts as the market wants, the market, I think, is going to be pretty disappointed. We have to remember also that it was November 1, 2023, that the market actually had been selling off. It had been dormant. It was negative. But November 1st changed it. And what changed it was the Treasury Department making an announcement that morning that the refunding was a little bit less than the market had expected, and that they would skew to short duration notes rather than longer duration. And in the afternoon on November 1, it was the Fed. And the Fed didn't come out and say they're going to cut rates, but there was a suggestion that they got it. They understood what the market wanted, and some suggested that actually there would be some rate cuts, but without any clarity. That changed the market. But this going into next year, we're going to have more funding needs, $7.5 to $8 trillion, and you're also going to have them coming out on longer duration. We have to see how those auctions hold up. It's going to be crucial. So that coupled with tariffs and the market trying to figure out, how much will be enacted, what the retaliatory response will be, the market has some uncertainty to have to deal with and get through it. But that's the market's job. And we still have geopolitical risk. The market has been absolutely incredible navigating geopolitical risk. You would think there was no problem in the Middle East. You think that there was nothing going on in Europe. But the market has basically said, as long as it's contained, we can keep marching higher.
Yeah, Quincy, it's interesting that you talk about tariffs. I want to pull up a quote from the recent Fed meeting minutes here. In the minutes, they say participants cited various factors likely to put continuing downward pressure on inflation, including waning business pricing power, the committee's still restrictive monetary policy stance, and well-anchored longer-term inflation expectations. I want to get your take on that line about waning business pricing power. Do you see evidence of that already? And how could a Trump 2.0 potentially impact that dynamic? And what would that mean for earnings growth? I mean, that just strikes me as a concern from the market's perspective moving forward.
Well, yeah, I mean, there is a concern. I mean, one of the things that really helped the market was pricing power. I mean, companies came in and they were able to keep raising rates, and consumers paid the price, small business owners paid the price, but consumers are much more discerning. They're spending, there's no doubt about it, but they are looking for more and more bargains. Also, something I think is interesting, and I hear it outside of the market commentary, and that is trying to beat the tariffs. In other words, trying to figure out what will be something that becomes more expensive in the United States, going out and trying to buy it now. And we're also hearing that a number of companies are also going and trying to increase inventory and try to beat the tariffs. So that could actually help GDP in the early part of the new year, but obviously the uncertainty regarding this is something that the market, markets like certainty, but the uncertainty regarding how this is going to unfold is crucial for the market. The market needs more information, and then we'll assess, is it going to be a 1% at the margin of higher inflation, or is it going to be less than that or more than that?
Yeah, well, we're going to have to wait to find all of that out, Quincy. The only thing that will bring certainty is time, unfortunately, in this situation. I want to dig into a couple of the groups that you like, and I'll take industrials, first of all, because that's an interesting one, given that outlook for tariffs here. Why is industrials a group that you like right now?
Because we expect to see more and more building. We're going to see building in the United States. That is going to continue. And we're going to see data centers building. Embedded in industrials is actually the defense names. And we expect to see more and more defense spending, not just in the United States, by the way, but money coming in from our allies. The president is adamant that they're going to have to pick up spending, and they're going to be buying quite a bit from the United States. They'll be buying also their own defense manufacturing names, but a lot of them just come in to the U.S. and buy from the U.S. So the totality of it is we expect to see the industrials do well, continue to do well next year.
And I know you also are interested in communication services, Quincy. Can you talk to me about your base case there?
Well, yeah, I mean, communication, companies need it, we need it, and I think it's going to continue. And if the Federal Reserve continues to lower rates, many of them offer very attractive dividends. And that's going to be attractive. It's always attractive when the Fed lowers rates, and you look for dividend players, and that sector is filled with them.
Quincy, good to see you. Happy holidays to you, and thanks for joining us.
Thank you so much. Thank you.
Thanks, Quincy. We're getting started here, just getting started here on Market Domination. Coming up, the season for spending is kicked off, yet Christmas is only 26 days away. So what sort of impact could that shortened shopping season have on retail sales? We'll speak to an economist on the other side to help us understand that effect. Stick around, much more Market Domination still to come.
The aggregate amount of spending, I think, will be fairly healthy, whether it's somewhere north of 3%, 3 to 4% growth over year over. But within that aggregate number, we're going to see some clear winners, and we're going to see quite a few losers as well.
If there is across-the-board tariffs adopted on consumer goods, it would really put pressure on family finances, and as much as $78 billion annually that would reduce consumer spending.
The consumer is willing to pull the trigger before they even believe that they're going to maybe get the best value, because there is this kind of turbulence and uncertainty, and they're willing to pull that trigger if they get something that they deem that permission to buy.
Holiday shopping unofficially kicks off today with Black Friday, and by a quirk of the calendar causing a late Thanksgiving, there are just 26 days between today and Christmas. Of course, a lot of people have been doing their shopping for a while already. Joining us to discuss the holiday shopping season ahead is Lauren Seidel-Baker, economist at ITR Economics. Lauren, thanks for joining us. So, people always pay a lot of attention to this sort of timing issue, right? Where does Thanksgiving fall? Where does Black Friday shopping fall? How should people be thinking about it, though? Does the holiday season start right after Halloween now?
It seems like it does. Increasingly, we're getting earlier and earlier, starting to see the sales, the holiday specials, et cetera. I think this year we really saw that trend. Now, historically, the numbers that we've run here at ITR Economics show no strong correlation between the seasonal strength of retail sales and how many shopping days there are in that post-Black Friday season. This year, I think that was an especially strong trend. We saw October monthly lift off of September, the highest seasonal trend it's been in more than 20 years. So I think the stores are pushing earlier and earlier, and they were especially aware of this calendar, knowing that they'd have to start just a bit sooner to grab those consumer dollars.
So then how much of a lift should we anticipate hearing about on earnings calls that this holiday shopping season is going to have for retailers?
I expect that October came in very strong. Again, we're waiting to see the November numbers very shortly. But given even these seasonal trends, we at ITR were expecting about 3.3% rise in overall consumer spending this year. Now, part of that is driven by inflation. So the higher costs are taking a bite out of consumer wallets. That margin squeeze is going to be present for a lot of businesses. However, this is a generally strong, stable consumer. We have a tight labor market fueling those higher incomes. So I do expect that our consumer has the propensity to continue spending this year.
Who is spending, Lauren, right? Is the bulk of that spending increase coming from upper income households?
Yes, we are, to be clear, seeing increase in spending across the board, but it's a little bit more muted at the lower income spectrum. I was looking at about 9% versus the upper income. It was north of 16% in that same time frame. So we do see, especially an income, or I hate to, not even sure what to call this, but maybe a home ownership gap, right? If you own your home, you locked in a very low mortgage rate, you're not seeing that higher inflation for shelter costs versus, say, someone who's renting and really seeing their rent increase. That's a little bit more of a squeeze on that individual. So much of it just comes down to our own individual inflation level. But again, overall, if you own your home, if you're a little bit more protected or higher income, you probably have extra money in the Christmas budget this year.
Lauren, it's a really interesting point. I was taking a look at some consumer credit card data this morning. On an inflation-adjusted basis, total household debt is $1 trillion below the record that was back in 2008, and credit card debt for the average household is 13% off of its peak. Help me contextualize that. Is that a good sign that there's consumer strength out there, or is it a sign that there's so much consumer weakness, people have pulled back on spending and therefore aren't putting as much on credit?
So we do see credit card debt rising right now. Now, a lot of our credit card debt metrics, they're very skewed today by the impact of that stimulus. We found that with the stimulus checks going out, so many consumers paid down that high APR credit card debt first. So to see those numbers rising today typically would be concerning. In this environment, though, I'm not so worried about it. I see a lot of these debt metrics about as good as it gets during a normal non-pandemic stimulus influence cycle. We're nowhere near those those concerning frothy, leveraged, over-leveraged levels that we saw pre-2008. So I do see more consumers putting it on plastic again, but there's also this disparity in what do I actually need versus want. We do see some trade down effects. So the types of items that they're buying, maybe it's the store brand, not the brand name anymore, or the, if you think of the good, better, best model, I just need the good one this time. So we do see a little bit of that skew right across our distribution.
I'm also curious, Lauren, it occurs to me as we're talking about credit, how buy now, pay later is factoring into this. I mean, just from some on-the-ground reporting that one of our folks has done, she's hearing from consumers that they're using buy now, pay later more and more. We're seeing that in the numbers as well. That doesn't go into the credit numbers, though, right? So I just wonder how that is playing into consumer spending and what that tells us about the economic picture, if anything.
That's correct. We are waiting to see, once we get this sector a little bit more developed, it is such a nascent opportunity that many folks are seizing on it, but we just don't have great data on that subject quite yet. We do see a bit of a skew here. Again, it's the ability to go out and purchase these things. Certainly our consumer willingness is the factor that's a little bit harder to gauge, but putting more money, more availability in these consumer pockets, that probably will have some supportive effect in the near term.
It's really interesting, Lauren. I went to a conference a few weeks ago and the head of a firm was there talking about BNPL, and he was saying that there's a misconception that it's lower income consumers utilizing that function, but it's actually middle to higher income consumers who are the majority of those users. What do you take from what that tells us about the state of the consumer and just kind of the vibe that the consumer has about our economy?
The vibe to the consumer, anytime I look at sentiment data, I'm a little bit thrown off because it just doesn't match the economic fundamental drivers that we see happening in their spending. So I think consumers really are shocked by the amount of inflation that they've seen, and that inflation, even though the rates are coming down today, inflation is cumulative. So they see the prices on store shelves. They know what that was just 3 or 4 years ago. And so I think even those middle to upper income consumers, they're making different choices in the sense that they just have that shock, right? That price shock. So maybe that's something like buy now, pay later that breaks it down into 4 smaller numbers, right? Mental accounting is a very powerful thing that we're willing to make different purchases, even if we would have bought that item overall. Again, it's going to be the smart companies who are really leveraging the consumer psyche in this case.
Yep, slowing inflation still equals inflation. Lauren, thank you so much for joining us this morning. Really appreciate it.
Thank you.
It's now time for some of today's trending tickers. You can scan that QR code on your screen to track the worst and best performing stocks of the session on Yahoo Finance's trending tickers page. We're going to take a look now at shares of MicroStrategy. Bitcoin rebounding this morning, though MicroStrategy moving to the downside, down just about 0.6%. The cryptocurrency Bitcoin still making its way towards that $100,000 level. It is up about 2% today. I know you've been covering this very closely, Julie, but it's been interesting with MicroStrategy in particular, those 5 convertible bond issuance so far. What can go wrong, right?
Oh, well, I mean, nothing. If you're buying the stock, I guess, you think nothing can go wrong. If you're Michael Saylor, you think nothing can go wrong. Right. But something else interesting that folks are watching for is that the Nasdaq does an annual reconstitution of its Nasdaq 100 index. And there's some speculation about what might happen with MicroStrategy. I believe after the close today is as of when they determine it, and then the change would happen in December. So that's just something to potentially to watch for MicroStrategy and the other companies that might end up in that index. But in the meantime, MicroStrategy is trading at a very steep premium to Bitcoin. If you look at its Bitcoin holdings, the cost at which it acquired them, and sort of do the calculations, which, full disclosure, I have not done, but analysts have done it. But Mark Palmer telling our Brian Sozzi in his opening bid podcast that the way MicroStrategy wants you to think about it is with a yield metric rather than that premium metric, and by that metric, it looks more reasonably valued. All of that is way above my head, but the point is that Michael Saylor is using MicroStrategy as a leverage machine to buy Bitcoin. And there's a lot of people who are fans of that strategy.
Especially if they are big Bitcoin bulls. Maybe they see it as a way to kind of diversify their Bitcoin holdings.
Maybe so.
Maybe so.
Yes. For a while there, it was there weren't as many ways to invest in Bitcoin as there are now with the advent of ETFs. Now there are quite a few alternatives.
That's a great point too, because it'll be interesting to see how that impacts some of these stocks.
Yes, it will. All right, well, turning to Meta now, that company reportedly planning to build a new fiber optic subsea cable for internet traffic. It's a project that could total more than $10 billion of investment. This according to a report from TechCrunch. Now, this is very preliminary. It seems like they're not building this thing yet. It's in the very early stages is what it sounds like. But this would be a more dedicated way for Meta to get its signal data around the globe.
And we're seeing all of the hyperscalers, as you know, Julie, investing in this kind of technology. Meta has been the second biggest investor so far, with Google being the #1 investor in these subsea cables. And again, as you kind of mentioned, Julie, these subsea cables, they carry 99% of the world's intercontinental data traffic. So as we see AI requiring more of that data traffic, you're going to see more news about these subsea cables moving forward here. One of the big questions, though, is the vulnerability of any targeted disruptions through geopolitical tensions, and that's a big concern. Meta spokespeople have spoken about this previously, the idea that there could be some issues with China moving forward. Could that play into any security concerns with their subsea cables? So that'll be something that they'll be investing into moving forward here.
Yeah.
All right, well, for the first time ever, a country has passed a ban on the use of social media apps. Australian lawmakers have approved a landmark law to prevent children 16 and under from using social media platforms. These include Facebook, Instagram, TikTok, Snapchat, X, and Reddit. Interestingly, does not include YouTube. Julie, this is so interesting to watch. There's a potential $50 million fine for some of these tech companies, and it puts the onus on the company itself to control use versus parents.
Yes, the parents aren't getting fined, the kids aren't getting fined, it would be the companies that are getting fined. But there are a lot of questions about how they're going to determine this, right? I think they're going to try to get the companies to report some of this, but it's difficult to understand. And I mean, there have been lawmakers in Australia who've been critical of this because they say most teenagers can pretty easily find their way around it.
Yeah, I mean, take a look at China, which has been the predominant blocker of these platforms previously. People are using VPNs to get around it, so there is kind of that roadmap there. And I think regulators in Australia, too, who were kind of against this decision, talked about fast-tracking it and not having those details ironed out as a potential issue here. And so it'll be interesting to see.
Yeah, well, I mean, there are states here in the U.S., like Florida, that have talked about doing things like this, too. So obviously it's a trend.
Right.
Whether it's here to stay, we'll find out.
Absolutely, we certainly will. Well, we're going to move forward here with Thanksgiving in the rearview mirror. We've now unofficially begun what's expected to be one of the busiest shopping seasons of all time. Yahoo Finance caught up with some folks out on the streets of New York City as well as Los Angeles to see how they may be planning to spend for the holidays. Take a listen.
The holiday retail rush is officially on, with shoppers expected to shell out $980 billion this season.
Picked up a couple of extra shifts, hoping to set aside around $500 for gifts for families, friends.
I'm budgeting around $400 for this holiday season.
Probably about maybe $3 to $5 grand.
The National Retail Federation expects a 3.5% bump in spending online and in store. That growth would mark the slowest rate in 6 years, despite improved consumer sentiment tied to cooling inflation and lower interest rates.
Like everything's too expensive. Prices are crazy.
Definitely leaning more into the promotions. If it doesn't have a promotion, I'm really not interested.
With Black Friday falling later this year, retailers began slashing prices early, rolling out promotions in October to make up for a shorter holiday season. Adobe expects stores to discount up to 30% off listed prices.
I'm just trying to budget and save money. You know, hours are getting cut a little bit, so trying to save and budget. So I'm just trying to use my Afterpay. I'll just pay it weekly or just pay it monthly.
Some of the steepest discounts are online, with mobile phone orders expected to account for more than half of all online buying. Electronics, apparel, and home goods among the top-selling categories. But retailers warn about potential downsides, with consumers still reeling from higher prices. Target forecasts flat sales during the holiday quarter, while Walmart warned about stretched pocketbooks despite raising its sales and profit outlooks.
We see that they're buying less general merchandise. As they're spending more on food, there's less money to go to some of those more discretionary type items.
I'm cautious about the future, but I think right now we're celebrating what we have now.
Supply chains for U.S. businesses are facing potential shifts due to President-elect Donald Trump's tariff promise. The potential changes to supply chains presenting direct short and long-term negative effects for businesses and consumers. The Atlas Network CEO Kareem Kafuri joins us now to discuss. Kareem, so there has been a lot of talk about supply chains that shifted after 2016 and the first round of tariffs here. What are the impacts that you think are going to happen as a result of this round?
Well, you know, it's definitely going to be a challenge for small to mid-sized businesses for sure, where they're going to have more direct costs. And as a result of this, they're going to have to make a decision on whether they're going to be able to absorb these costs or if they're going to pass them off to their customers themselves, therefore the American consumer. And what will that basically mean for all of our buying habits and the availability of products and the skyrocketing cost in particular industries and categories?
Since you mentioned small and mid-sized businesses, I want to ask you about some of the promotions that we're already seeing from those small businesses about pre-tariff sales, essentially, you know, doorbuster sale, get it now before Trump's tariffs set in. Help our consumer listeners out who are listening to this. Should they believe the impact that tariffs are going to have at all of these smaller businesses that are promoting these pre-tariff sales?
Yes, absolutely. I mean, if we look at what countries are involved, you know, Mexico, Canada, China, and the industries that are involved, such as electronics and automotive, even the cost of food products. I mean, Thanksgiving and Black Friday may be 25% higher next year, potentially. The idea here that we're trying to get ahead of it and trying to buy before these tariffs come into play is valid, absolutely valid, and something that buyers and shoppers should be aware of. I think the most important thing as we go forward here is to have a proper equilibrium between some of these economic sanctions to curb behavior between nations and the impacts to the American consumer. And this will have to be something that is actively monitored by the administration to ensure that we don't move towards areas of potential inflation and then worst case scenario, potential recession.
Kareem, it's pretty confusing right now, I think, when it comes to the tariffs, because we're hearing the rhetoric that's already coming out even before Trump takes office. But there are a lot of certainly investors who we speak to who assume that this is a negotiating tactic and the tariffs won't actually ever be implemented. If you're an investor, that's one thing when you're trying to make decisions. If you're a business who's trying to make decisions ahead of these maybe tariffs, like how do you factor in that uncertainty piece of it?
The reality is, and I write a lot about this in my book, Supply Chain Ups and Downs, is that there are controllable factors in business when it comes to the supply chain, and there are uncontrollable factors. And businesses of all sizes need to always be prepared to navigate challenges that may come about through political changes, environmental changes, force majeure, such as, during the pandemic and other areas. And you need to be nimble and adaptable. So I think that any small to mid-sized business these days in America needs to be looking ahead to see what areas these tariffs will impact for them, if they will be able to absorb the difference if there is a cost differential. If they can't, can they pass it off to their customers? And that will depend industry by industry. Can they do some reclassification potentially of some of their goods that may impact the tariffs or duties levied? And then finally, if they can't, can they look for alternative supply chains in different geographic areas which may or may not be impacted? So, I do believe that businesses need to consistently be looking for creative manners on how they're going to navigate in the global landscape if such tariffs can impact them and how it won't have a detrimental impact to their consumer base.
And based on your expertise on supply chains in particular, is there a risk of companies kind of rushing to invest in these new supply chains, and then in 4 years these tariffs potentially get rolled back and they've spent all of this money on supply chain challenges that potentially don't exist after a Trump 2.0 regime comes to an end?
I think that that's going to have to be sort of a business to business and industry to industry conversation, really. And oftentimes some businesses may say, in order to completely recreate my supply chain may take 1 or 2 years. Right. And in the in-between, maybe we could weather this storm. We could take on these additional costs, reduce some of our profits, maybe reinvest in other ways in our businesses to still be, in a good and, manner to basically still facilitate work in the American economy. But it is going to be business by business, industry by industry to determine if they need to pivot away or create entirely new supply chains. In some cases, it may be a quick decision, and in others, it may take a couple of years to redevelop supply chains. So it's really something that even can't be discussed.
Kareem, what do you expect the pass-through rate to be, given what we've perhaps seen in the past in situations like this?
Well, I believe that, again, it's really going to be industry by industry. And I think that's the most important thing. I believe that some areas there will be able to be an amount of absorption. I believe in other areas there may even be able to be a negotiation that takes place between both the suppliers and their businesses as well to share some of these tariffs so that you don't have as much of a pass-through to the American consumer. And then in other areas, I do believe that we're just so dependent upon particular supply chains, and it's going to be very complicated to redevelop or recreate them. So in that way, pass-through and increased costs are going to be an inevitability.
All right, Kareem, we got to leave it there. Thank you so much for joining us this morning. We really appreciate it.
Thank you so much. Appreciate it.
It's time now for our call of the day. Bank of America upgrading European stocks to overweight, saying there are undervalued opportunities. It's interesting, Julie, taking a look at this note. They say they believe European equities' recent 15% underperformance since Q2 and their pricing for weak domestic growth present a buying opportunity. This comes obviously as stock valuations in the U.S. rising faster than usual. So as a comparison point, maybe that weakness we've seen in Europe is actually a sign of something to come down the line here.
Yeah, I mean, it's definitely a contrarian call because most people we talk to still like the U.S. best in terms of international, markets around the globe. I'm looking at the Euro Stoxx 50, which is one of the benchmarks for Europe. It's up about 6.25% this year. Compare that with the S&P 500, which is up 27%. And you see, that's obviously a reflection of the people weren't that excited about what was happening in Europe. We are expecting, or economists are expecting, I should say, more cutting to come, more monetary stimulus to come in Europe than in the U.S. So, that also might be a reason that the Bank of America folks are looking for it, that there is more room to go upwards from here after what has been that underperformance. It's interesting, Michael Hartnett, also Bank of America, on a separate team, in a separate note, said there is a quote-unquote extreme disconnect between investor bullishness on U.S. assets and what we're seeing from the rest of the world, where people are not as excited.
Well, it is the U.S. exceptionalism story that we talk about so often here. One of the stats I was looking at this morning is that 50% of the global market is in U.S. stocks right now. So how do you kind of bet against that? It's to your point, a very contrarian call. But then at the same time, you have global CPI numbers coming off their lows. Maybe it's a sign of getting in to a growth story before we see that rotation. You can make a lot of money that way, but again, when you have the valuations that we do in the States, it's hard to bet against the 2-year rally that we've had here.
Yeah. All right. Well, we'll see what happens.
We will. As always, we will.
On the latest episode of the Yahoo Finance podcast, Financial Freestyle with Ross Mack, Web3 Media President Chris Lyons sits down with Mack to break down the differences between iterations of the web. You can scan the QR code below to check out all the latest content and stay up to date with episodes. Be sure to tune into Financial Freestyle every Monday at noon.
Where you could actually read things on the internet, right? And then the next component was the write era. So you have read and write. That's what we call like the Web 2. And then you saw companies like Facebook and Pinterest and Airbnb and like so many different businesses in the 2010 era. The big difference between what was going on in quote unquote Web 2 versus where we are now with what blockchain technologies can really encourage is this ownership layer.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Black Friday is here. While consumers are likely to spread their shopping throughout the holiday weekend, Black Friday remains the most popular day to shop, at least of the holiday weekend time. 72% of consumers plan to shop online or head out to stores for Black Friday. That's according to the National Retail Federation. For more, let's go to Yahoo Finance's Akiko Fujita. She's on the scene at a mall in Glendale, California. She's been there throughout the day. Looks like it keeps getting busier and busier behind you, Akiko.
Yeah, Julie, traffic certainly picking up here at the Glendale Galleria. You know, retailers are looking for a strong finish going into Christmas Day, especially when you consider they have 5 fewer days in this particular holiday cycle. Now, if this mall is any indication, there's certainly reason for optimism. The Glendale Galleria expects 90 to 100,000 shoppers to come through their doors today alone. That's about a 4% bump from what they saw last year. When you look nationally, the National Retail Federation expecting 183 million people to be shopping over this extended holiday weekend, with 2/3 of that shopping coming today on Black Friday. Now, we have been talking about Black Friday as the official start of the holiday shopping season, but the reality is these discounts have been rolling out over the course of the last several weeks, as early as October, because of this shortened holiday cycle. The National Retail Federation saying that's part of the reason why they have seen retail prices coming down on a monthly basis when you look at things year on year, although we're talking about just a 1% decline. The NRF's economist speaking to our morning team earlier today saying that puts these stores in a strong position this holiday season.
At this point, prices are very competitive for retail purchases this holiday season, and we think that the underlying state of the economy is in a good place. So, despite interest rates and still some elevated inflation, we're kind of confident this will be a very good holiday season.
Now, Americans are increasingly opting to stay at home and shop online. And when you look at the numbers, they have certainly been increasing in a big way. Adobe forecasts consumers to spend a record $241 billion online this season. That's about an 8.5% jump compared to the previous year. Yesterday alone, consumers spent more than $6 billion online, a vast majority of that coming on these very devices on mobile. Now, we've had a chance to speak to a number of shoppers out here today, asking what kind of discounts they're finding, what exactly they're buying. A vast majority, when you look nationally, it is on electronics. That's a significant part of the purchases we're seeing during this season. Apparel and grocery, the only other categories that are outpacing that as well, guys. But it's interesting to see that there are still people who are coming out here saying, yes, we like shopping online, but we still like to do the early post-Thanksgiving shopping in store because there are still deals. And yes, the lines are shorter early in the morning, guys.
I know you've been up since very early in the morning on the West Coast covering this for us at Kiko, so thank you so much for making the time for us this morning and bringing us your reporting. We appreciate it. Now, those expectations are set for a record number of shoppers and consumers online spending this holiday season. U.S. consumer online spending in November prior to Thanksgiving already trending above Adobe's full holiday season growth forecast. That's, of course, according to Adobe Analytics. For more on how consumers may finish out the shopping season, we've got Natalie Cutler, BDO National Retail Practice Leader. Natalie, great to have you on with us this morning. Help me put this into context. We were just speaking with our reporter, Akiko, on the ground at one of these shopping centers on the West Coast about how it is a record shopping season. If the sales have lasted for what feels like a million years, is it really a record this year compared to previous ones?
So I do think it's going to be a strong finish to the holiday season. I think that given we saw October was a relatively flat month from a retail perspective, from a retail revenue perspective. We've had the elections, those are behind us in many cases. That has created distractions and uncertainty in the retail environment. But we have seen that consumer confidence is up, highest actually since July of 2023. And as we just mentioned earlier, there is a shorter period between Thanksgiving and Christmas of only 27 days. So we are considering all of that. We believe that the consumer is primed for holiday shopping.
And then how are retailers capitalizing on that, Natalie? What is the strategy this year? How has it changed, if at all, to try to get people through the door or to click on their shopping carts?
So this is actually a really critical month for the retailers. They really need to execute and deliver on their strategy. So whether that includes their promotional strategy, creating an excellent consumer experience, they have to continue to be relevant and meet the consumer where they are. And probably the most important thing is make sure that they have the appropriate stock.
Talk to me about that moving forward, because the inventory problem is something that we've been speaking about throughout our shows, and especially in the context of the incoming Trump administration, how tariffs could impact that inventory problem moving forward. What are you hearing from retailers about that?
So I think a lot of retailers, we're hearing that there's really two strategies or two approaches. There is the wait and see approach, see what happens. How does this ultimately unfold? Since there is still uncertainty as to what will happen and when. Some are being more proactive, whether it's in the short term of stockpiling inventory, making sure that they get a lot of inventory in-house so they can have it for sales. And then also reevaluating their supply chain strategy and making sure that they have the right suppliers in place, diversifying their sourcing strategy. Because we do believe that those retailers that have the ability to pivot and to move quickly could see an advantage in locking in the right suppliers and even get favorable pricing.
I'm also curious on the pricing front when it comes to the price that the consumer is paying, how much discounting we're going to see this year compared with prior years.
So I think that we're seeing a significant amount of discounting because the retailers are looking to get the consumers in the door because this is it. This is the time where they need the consumers to buy. So there is a good amount of promotional activity that we're seeing now, both online and in stores.
So for consumers, Natalie, what's the best day to shop? Like, when are they actually going to get the best deals on sales? Again, particularly given that it's been such a long Black Friday season.
That's a really great question, and I'm sure everybody wants to know the answer to that. So, the consumers want those promotional activity to be high and soon, and have it as many promotions as they can get. And it's up to the retailer to really identify at what point do they need to start marking things down further. As we just heard, Black Friday, today, tomorrow, this whole weekend is going to be a significant shopping experience for the consumer. But let's not also forget about Cyber Monday. Although consumers are spending a lot of time online and making their purchases through e-commerce, there is still an expectation that Cyber Monday is going to have additional discounts.
All right, something for consumers to look forward to. If you're not getting out there today, you've always got Monday. Natalie, thank you so much. Really appreciate you making time for us this morning.
Thank you.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following that closing bell. So stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street. And now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the session. We saw a little bit of a downdraft at the end of the day here for the Dow, but still up 192 points on the day and closing at a new record high for the Dow as well. Also, we talked about how it was the winner of the month among the three major averages, although the Russell beat it, but it was up 7.5% on the month. The S&P 500 on the day up a little better than 0.5%. It too closing at a record. I think we're at 53 for the year in terms of the number of record closes, but maybe Jared can keep me honest on that figure. And then the Nasdaq up about 0.8% on the session as well. So after kind of muddling along, a little bit of a choppiness introduced this week, a strong finish for the major averages. I mentioned the Russell 2000, so let's check on that one because we've been watching it very closely. Up 0.2% on the day. On the month, it's been a monster here, up 11%. Now to Jared, he's got a closer look at the action. Hey, Jared.
Thank you, Julie. Yeah, we're looking at for the Dow, the S&P 500, and the Russell 2000. It looks like this is the best month in a year. So you'd have to go back to November of 2023. And let's just go through some of the other indices and markets that we've been tracking all month. Here is the VIX. Volatility, you want to see that dropping if you own stocks, if you own risk assets. So we're seeing that head lower here. Finishing here at 13.68. A 13 handle is pretty bullish, historically speaking. Then we've got the VIX of the bond market. That's the ICE of A Move Index. That has dropped steadily, and you can see this looks like the lowest close of the entire month. So that's supporting risk assets as well. 10-year T-note yield. We had a little bit of a scare with the election, and it looked like rates were trying to go to 4.5%. Then we got a reprieve, and we can see over the last few days we've dropped off quite a bit here. And going down the line, U.S. dollar index, similar story to the 10-year. It is off of its highs as well. And even Bitcoin. We can take a look at Bitcoin and we can see up 20% over this last month. Well, let's take a look at some of the sector action, and I'm going to switch this to a month to date, all 20 days here. Consumer discretionary, one of the best performing sectors of the year now. That is up 13%. That is in the leadership position. Financials also doing very well, 10.5%. Energy, industrials, communication services, all of those are outperforming, and they round out the top row there. Even healthcare, which had a lot of problems in some various names this month, that was up, finishing up 0.3%. Guys?
Jared Blickery, thank you so much. Always appreciate you. For more on the latest market moves and what to expect moving forward here, let's welcome in Ross Mayfield, Baird investment strategist. Ross, great to have you on here. I mean, reading all the notes, the price target increases for next year, the idea that gains beget more gains, 2 years of gains, why not get a third? What could potentially stop the market's party here?
Well, there's always no shortage of headwinds, right? The question is just whether they outweigh the things the market has going for it. You know, rising earnings, Fed cutting interest rates, the election in the rear view. I mean, if you look at what has stopped the upward ascent of this market since it began in October of 2022, you would say higher Treasury yields. And that's a pretty simple one. But if inflation expectations and amid all of the stimulus and potential tariff policies get out of hand and you see that 10-year push up towards 4.5%, 5%, that has been something that has stopped this market in its tracks a little bit over the last couple of years. Obviously, the trade and tariff stuff we'll be watching closely, but really hard to say at this point that that's going to be a major impediment to the market when, you know, in 2018 and 2019, the market was volatile, but fine.
Ross, I know you watch seasonality pretty closely as well. I mean, December tends to be a strong month, but given that we've already seen so much strength, did that sort of pull forward some of those returns?
Potentially, but it's not something we would want to fade here. There's a very strong seasonal impulse in November, December, and really in January, if you go back through history too. So I do think as we're talking about potential headwinds, as we're looking at sentiment getting pretty hot, I think that there's, you know, it all comes together for the potential for, you know, a 5-10% correction at some point in the first half of next year. But I do think you need to get through this, you know, seasonally strong period where trading is a little bit light and look towards the first quarter of 2025 for when you really start to get a little bit of volatility that could creep back into markets.
And there was this idea, Ross, that there was going to be all of this pent-up spending, particularly from corporations following the outcome of the election, that there'd be more hiring and just more corporate spending in general. What are you going to look at to suss out whether or not that bears fruit in the new year?
Yeah, I think you said it. So spending, CapEx, very important, but the main thing is hiring, right? This economy of ours is a consumer economy. People spend if they have a job and if they're confident they could get a better job if they wanted one. We saw that non-farm payrolls report last month look very, very weak. So the hiring was down. Now, it seems like the market is looking past it, kind of calling it a one-off on hurricane or strike data. But if we see a second straight month of weak job gains, and if we don't see those gains pick up into the first quarter of 2025, that's when I will start to get a little bit worried, because at the end of the day, the job market really drives this economy. And so we want to see companies starting to reinvest in their labor force as we move into this new administration.
Ross, something else that's been a big trend this year has been the momentum trade, right? That's been the factor, to use some financial industry jargon. That's been the factor that's worked the best. Things that have gone up have tended to stay up. But the sort of ultimate momentum trade had historically been tech, and that has started to lose a little bit of momentum. So where does that go from here?
So we think about tech in a couple of ways. I mean, on one hand, for long-term investors, you want to have exposure, in my opinion. You want to be levered to secular growth stories like AI, like all of these productivity enhancements in a lower growth world, right? Even if the economy is doing better than most expected, we're still in kind of a lower growth world where these tech companies can bring their own growth to the table, and AI is something you want to have in your portfolio. You know, in the near term, however, you're right. And it's not just recently. Tech has been kind of relative laggard for the past 3-6 months, while cyclicals like financials and industrials have kind of taken the baton. Honestly, looking into 2025, I see no reason why those types of trade won't continue to be leadership, discretionary financials, industrials. And tech, I think, is not going to, be last of the pack, but might struggle a little bit. I do think there's a broader question of all this investment into AI and data centers and tech infrastructure. When does it start to pay off? I think investors are going to want to see answers to that question in 2025.
They certainly do, but in the meantime, they're continuing to invest in these kind of side AI plays. I'm taking a look at Vistra, the best performer in the S&P year to date, up a whopping 316%. How are you thinking about these kind of second tier, third tier AI plays heading into the new year, and where are you seeing opportunity?
Yeah, AI, that is a really great question. So this first leg of AI is going to be all about, it's building out the infrastructure, right? The second leg, I think, and our partners at Strategas have talked about this a lot, is the need for the power to fuel the infrastructure, right? So you look at utilities, which have had a really nice year, and you would think, well, this market is risk on. Why are utilities doing so well? Well, if they're a power play based on all of the need from this technology infrastructure, then it makes some sense. I think the next leg, and maybe still a little bit away, is what are the killer applications that get layered on top of all of this infrastructure, right? 4G and mobile internet, it really laid the way for things like Uber and Snapchat and things that you could do on your phone. So I don't even think we've begun to scratch the surface of the consumer-facing AI apps that we could see. And then on the flip side, the promise of AI to us as a productivity enhancer is making the least efficient companies a little bit more efficient, letting that compound over decades, and it turns into huge gains. So I want to see your consumer staples, your utility companies, your healthcare companies get a little bit more efficient with their processes, see that flow into margins, and then ultimately, flow up to investors over the long term. So that's what we're keeping an eye on. It might not be a 2025 story, but the back half of this decade, I think, is going to be all about what can we use this infrastructure to build.
Ross, finally, I want to circle back around to Washington and what we're waiting for in this Trump administration. There's a lot of questions about tariffs and what's going to happen. What we do know is that Scott Bessent is the Treasury pick, right? We do know that Kevin Hassett's going to be head of the NEC, and the market seems to like all of that. How much confidence do you have in these picks in terms of how they're going to sort of steer the economic ship?
Yeah, the market is going to root on some of its own, right? So getting some kind of Wall Street veterans in key positions there to maybe tamp down the worst impulses of anti-growth tariffs, I think is obviously a win. Bessent, the bond market seemed to like it. A focus on getting the deficit down is another thing that, at times the bond market vigilantes have cared about, maybe not as much lately. So Obviously, on the margins, I think it's a positive to have folks who've been on Wall Street, know what the market likes, know what drives economic growth. They're still going to lean on tariffs as a negotiating tool. And ultimately, I would expect to see plenty of tariffs get levied. But if they can tamp down on some of the worst impulses there, the most, I guess, anti-economic growth impulses, I think it's a win. All across Trump's first term, there were tariffs and trade wars and threats lobbied back and forth, and it was a lot of volatility. But ultimately, again, the market finished higher and inflation never really spiked across 2018 and 2019. So we would hope to see something similar again. And I think having Besson and others in the room will be helpful there.
Ross Mayfield, thanks so much for making time for us. Appreciate it.
Thank you.
Well, President-elect Donald Trump's economic team is taking shape. Yahoo Finance's Rochelle Akufo broke down those key picks for us.
President-elect Donald Trump's economic nominees are in stark contrast to his other more controversial loyalist cabinet picks. Trump is prioritizing experience to deliver on his campaign promises to rebuild trust in the economy. So here's a look at his top 5 key picks so far. Now, the most significant cabinet role to U.S. fiscal and economic decisions is Treasury Secretary. When hedge fund manager Scott Bessent, founder of Key Square Group, was nominated, Wall Street cheered the news as a safe pair of hands. But take note of his ambitious 3-3-3 targets. 3% GDP growth, cut the budget deficit to 3% of GDP in 4 years, that's halving current deficit levels, and a 3 million barrel increase in daily oil production. Now, economist and former Trump administration official Kevin Hassett is prioritizing inflation, tariffs, and extending Trump's tax cuts as he analyzes economic data trends. Now, he'd work closely with Bessent. Now, Hassett is also considered a more conventional choice with a more moderate approach to tariffs. And Trump's pick for Commerce Secretary is Howard Lutnick, the outspoken CEO of global financial services firm Cantor Fitzgerald. Now, if confirmed, he'd be overseeing U.S. trade relations, business policies, and economic growth. Now, he supports targeted tariffs on goods that the U.S. makes versus across-the-board tariffs. Now, he's noted that tit-for-tat trade retaliation would bring tariffs down globally. And another former Trump administration official, international trade attorney Jameson Greer, is tapped for the U.S. trade representative position. In a statement, Trump said in his first term, Greer was instrumental in imposing tariffs on China and the USMCA trade agreement between the U.S., Mexico, and Canada. Now, Trump announced plans to impose 25% tariffs on all goods from Canada and Mexico, likely a negotiating tactic, as imposing blanket tariffs would actually violate the current USMCA. Also returning to the role held under Trump, if confirmed, Russell Vought as director of the Office of Management and Budget. Now, Vought would prepare the federal budget and oversee spending. He co-authored Project 2025, the Heritage Foundation's controversial blueprint for Trump's second term. Now, this includes significant spending cuts, restructuring entitlement programs, including Medicaid, and limiting the role of government with more privatization and deregulation. But it is unclear how much influence outside Advisory Department DOGE, headed of course by Elon Musk and Vivek Ramaswamy, will have on these spending policies versus the influence of cabinet officials.
AI is rapidly becoming a lifeline for businesses around the world, helping them to streamline operations, serve their customers better. Many retailers in particular are deploying generative AI this holiday shopping season in an effort to connect shoppers with the items they want and expedite the buying process. Joining us now, Eric Fish, HSBC Head of Retail and Apparel, U.S. Commercial Banking. We were just talking during the break about how my husband asked ChatGPT what we should buy for our son. And it was a very long list. I don't really know what to do with. How are retailers using this? How are they investing in it right now?
There are definitely some real practical applications, some defensive. So there's been a lot of talk around theft. And so AI triggering cameras and finding suspicious activity, identifying things to look at. If you think about a regular retail store, 6, 8 to 20 cameras. No one can monitor all those at the same time. So that's one element. On the other side, on the sales side, there's AI that's tracking and heat mapping the way people flow through a store, where you actually glance, where you're reaching out for product. And so helping retailers better position product. And then certainly on the conversational customer service side. So when you chat, that chatbot is getting better and better at sounding like a real person.
What is the ROI of all that AI looking like at this point?
Yeah, so for the retail side, different than the broader industry. Not a lot of retailers are spending a lot building out their own models. These are mainly plug and play solutions. So the ROI is pretty quick because it's just paying for a service, integrating it into your formula, and just continuing.
It's so the part about theft is really interesting to me. So basically, the AI can analyze in real time while it's happening. This person is doing something that would be suspicious given all the data we fed into the model. What is happening with shrink, as the industry calls it generally? We have seen an improvement, right? Is that part of the reason why?
Yeah, it would be great if that was already making a massive impact. I'm not sure. I think it's
early days.
It's early days for that element, but a whole host of reasons. There's been a lot more press around it, and therefore a lot more scrutiny. I think stores are repositioning product, moving more valuable product to the back. Unfortunately, some of the product is harder to reach, even for shoppers who are genuine. And then enforcement has certainly increased. But shrink, as a historical average, only ticked up very slightly, even when we all saw all those stories. It was really some of those extreme cases of entire stores being looted that we all sort of touched on, but generally not as big an issue as I think we all sort of saw.
So then what is the big risk for retailers? When you're talking with clients, what is the big worry that's making their eyebrows come together right now?
Yeah, heading into the election, it was just uncertainty and anxiety among shoppers. Will they be out there? Will they be shopping? And so all the clients I spoke to leading into holiday, they really took a very defensive approach. Didn't overbuy inventory, didn't overspend on social media advertising, didn't overspend on new stores and hiring. And so they came in a position where maybe they couldn't necessarily hit a home run, but at the same time wouldn't get hurt. So I think the discounts we're seeing, the markdowns, are strategic. They were all built into the model. And I know I personally have already seen some sold out items on websites. I think those are going to stay sold out because people kept their inventory shallow. They don't want to get stuck with too much product, and they're just going to take it as a win if they could get through the season in a healthy way.
Really interesting that you mentioned that, because we've been talking with a lot of folks today about tariffs and the effect that they might have on the industry, the anticipation that retailers have of the tariffs. So lean inventories, the current state. Are we starting to see any buildup at all in anticipation that items will be tariffed?
Yeah, I think there's an element to that. I think that the important thing to remember is that there's such a broad range of categories, some of which are in countries that have not been mentioned for tariffs necessarily. And there's other products that are very difficult to move just because of the infrastructure, the amount of the elaborate process of manufacturing them. And so I do think we're going to start seeing that build up. I heard Natalie mention it earlier in the hour. I think people are going to stick to core products, right? It's styles and items that sell year in, year out. It's not going to suddenly be a risk on.
Okay, so it's just fewer risks being taken on newer stuff on the part of the retailers. Interesting.
Yeah.
What risk does that present to not kind of go in on newer products that could be enticing for shoppers?
Yeah, I think you put it perfectly, that the risk is if you sort of deviate towards your classic styles, you risk not expanding your universe of shoppers, right? You're sort of selling the same item day in and day out. You need to refresh the assortment. And so to the extent you're not taking risk on style, you're not necessarily attracting that new shopper.
Just sort of big picture here. You talk to retailers all day long. That's what you do. How are they feeling this holiday shopping season compared to recent years past?
Yeah, cautiously optimistic, I'd say. People really, post-election, the numbers were up. November has been a strong month for nearly everyone. I think going into December, they expect that to hold. Next year, again, I think cautiously optimistic is the right phrase. It's approaching it for steady growth, single-digit growth, good margins, right? If you're not discounting, then your margins are strong, and being very disciplined around expenses. A lot of companies sort of taking an approach to marketing that's let's do A/B testing, let's remove this item, and if that doesn't make an impact, we could save that money.
That's also important in the context of this idea of increased corporate spending. That's going to be a rally for the S&P. It sounds like you're not seeing that in retail at least.
Not in this sector.
All right. Eric, thank you so much. Thanks for coming in studio with us on the holiday week. We really appreciate it. Thank you. Well, it's been a very busy week here at Yahoo Finance, so let's take a look back at what you might have missed over the past few days here.
President-elect Trump announcing billionaire hedge fund manager Scott Bessent for Treasury Secretary.
This is the exact pick the market wanted.
He's mainstream. He knows a lot about the world of finance.
Among the kind of spectrum of Trump cabinet appointees, this one is likely to kind of get through quickly.
I'm not a fan of broad-based tariffs. They make me really uncomfortable, nervous.
It will not be good for the consumer or for us retailers.
It is a headwind because it causes prices to be raised.
Which, by the way, is a reason why I think this won't happen.
Here at the Glendale Galleria, they are expecting anywhere from 90 to 100,000 people.
It's become a social activity again, and I think that's why we're seeing some uptick in the traffic in these malls.
It's a fun, spirited time. Those crowds definitely come out for Black Friday.
We're starting to see a bit of a comeback of those doorbusters that we saw once upon a time.
Having amazing fashion, but also an unbelievable price. Happy Black Friday.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
This November marks the second anniversary of the launch of ChatGPT. Since then, artificial intelligence has set a high bar here for big tech. Here with more on how AI has lifted these big tech names, we've got me, Madison Mills. I'm going to pull up some charts behind us here on the investment we've seen from these hyperscalers in ChatGPT. It's been really interesting here. If you take a look at this chart behind me, this is NVIDIA, Microsoft, and Alphabet, the contribution of these names to the $8 trillion market cap add of these hyperscalers to the S&P 500 since the addition of ChatGPT. You can see here, it's interesting. NVIDIA, you would think, would be the biggest contributor here, but actually, according to this chart, Alphabet is one of the bigger contributors in terms of market cap gain since the launch of ChatGPT. I want to flip the board over to those other tickers here so I can take a check on those numbers here. We've got Apple, Amazon, and Meta, also big contributors. You can see Apple having that sluggish start. And if you remember at the beginning of this year, there were a lot of notes about some headwinds for Apple moving forward. They were behind on AI, and we've certainly seen them picking up, particularly in the back half of this year in terms of spend on AI moving forward. Now, it's interesting, while we've seen big tech's market cap popping since the launch of ChatGPT, consumer sentiment around AI has actually worsened in those past 2 years here. Trust in AI has gone to 27% in 2024. That's down from over 30% back in 2020. Around 65% of Americans also don't trust CEOs that develop AI to regulate their products moving forward here. So that's going to be another big story that we're going to watch here at Yahoo Finance heading into 2025 as OpenAI moves to become, instead of a public benefit corporation, potentially moving private, or public rather. What does that mean for consumers and the safety of AI? We will continue to monitor that and more for our viewers here. Julie.
Interesting stuff. Thanks, Maddie. Well, speaking of AI, is it better at diagnosing illnesses than your doctor? A study found that ChatGPT was able to diagnose medical conditions better than a human person doctor. Here with more is our very own Anjali Kamlani. We've been sort of monitoring these kinds of stories and studies to try to understand how AI, generative AI specifically, could fit into the healthcare picture.
Yeah, we've seen over the course of time where there have been small studies just like this one that have confirmed the idea that generative AI can, in fact, like you see on your screen, get the diagnoses. It's been pretty focused on things that you can train, a large language model to find, like images. So imaging has been a key area for that, where they have seen pretty high accuracy. In fact, they've even seen where, in some cases, it performs better than a doctor just solely on the visual parts of it. This study also, a small one, I have to point out, did also find that ChatGPT got to the answer a lot faster. When doctors were using ChatGPT versus just by themselves, the difference was pretty small, but still did give the doctors using the technology a leg up. So I think this just opens the door to a little bit more focus on how you can include it, because I think the healthcare industry, broadly speaking, doesn't want it to go away, doesn't want humans to go away in this process, right? We want a doctor to still be participating in this process. There are also other areas where we're starting to see a little bit more use of it. AI scribes, for example. So when you're in a doctor's visit, that doctor is going to have an AI taking notes, finding the keywords to kind of summarize what drugs you're supposed to be on, what the diagnosis was, et cetera. And then also looking at chat boxes. So if you're on a telehealth platform and the like, there's been studies that say that, the machine is better at staying nicer for a longer period of time than if you were to interact with a normal doctor, which, I mean, come on, at the end of the day, you're going to, as a human, we have emotions. We're trying to get through everything, get through it.
Yes.
The bot has forever to talk to you and is not being paid on that, so.
Wow. All right, thanks, Anj. I know we're going to keep talking about this. Appreciate it. Time now for What to Watch the week of December 2nd. On Monday, we'll get ISM manufacturing data for November with an average estimate of 47.6 expected. The numbers for October came in below expectations at 46.5. That was under the average estimate of 47.6 in the sharpest contraction that we've seen this year. On Tuesday, we'll get earnings from Salesforce. The street expecting revenue and profit gains year over year with an adjusted earnings per share estimate of $2.44, revenue of $9.35 billion. Morgan Stanley has got a buy rating and a $330 price target on Salesforce, says investor interest around software companies positioned to benefit from Gen AI has increased, where Salesforce's Agent Force platform appears well positioned.
That was a tough one.
Salesforce's Agent Force.
They've got a lot of agentic forces out there. All right, Tuesday, we'll get the JOLTS report for October. September's report showing there was an estimated 7.4 million unfilled jobs, a drop from August's number there. Moving forward here, if we can scroll forward here on Friday, we're going to get the number of unemployment data for November. October's rate coming in at 4%. That was the same as September.
And that'll do it for us. It's a wrap on today's Market Domination Overtime. Enjoy the holiday weekend, everybody.
Thanks so much for joining us here on Market Domination Overtime. Appreciate it.
Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line. I'm your host, Akiko Fujita. Now, as a candidate, President-elect Donald Trump laid out a slew of tax proposals, including a promise to make his 2017 tax cuts permanent. Last week, Trump appointed billionaire hedge fund manager Scott Bessent as his Treasury Secretary. That was before he put out a new proposal on tariffs for U.S. imports coming in from Mexico, Canada, as well as China. Now, with Bessent now poised to lead the Treasury Department, the question is, can Trump implement these tax reforms, and what impact will they have on the economy? We'll dive into that later on in the show with Garrett Watson. He is Senior Policy Analyst and Modeling Manager at the Tax Foundation. But as always, we begin with our co-stars, Rick Newman and Ben Worschkel. Ben, what do you have on your note cards?
So what I have got, don't call it a comeback, but I have got the return of Tariff Man, Donald Trump's return of tariffs. So the headline here is that he's going to do, the president-elect is promising 25% blanket tariffs on Mexico and Canada and new 10% duties on China. That's in addition to any additional tariffs he wants to do later on. So it's basically just a kind of re-underlining of what he talked about the entire campaign of his tariffs. The stated reason for this round is drugs and illegal immigration. And he's basically, but it's about to set off a whole chain of diplomatic and legal back and forth. It's going to probably continue all the way through Inauguration Day. Mexico's already talking about retaliatory tariffs. There's expected to be some sort of concessions offered. And the question is whether Trump kind of takes a win here on small measures, or he kind of goes through with this. And if he does go through, it's a whole lot of legal questions that kind of come ahead. We're all going to learn about things like the International Emergency Economic Powers Act of 1977, which is the way he might do this sort of thing. That's what he's expected to do. So it's a kind of complicated picture that's going to play out for a long time that he kind of set the starting gun on this week. Rick, how do you see it playing out?
So does anybody know what Trump has against Canada? I mean, what is he going for there? So Mexico and China he's picked on them. He picked on them a lot the first time around. Of course, we know he already did a round of tariffs on Chinese imports, and those are mostly still there. Biden left those in place. Mexico, Trump obviously has grievances with regard to all the migrants coming across. I mean, I don't really know what Canada. I mean, I don't think too many migrants are coming in from Canada or fentanyl's coming in from Canada. But Trump wants some leverage. I guess he's going where the money is. Those three countries are the top three U.S. sources of imports to the United States and our largest trading partners overall, which means we also export a lot of stuff to those countries. So this is going to be interesting. But I'm detecting a more subdued market reaction this time around, and maybe for a couple of reasons. First of all, I think we know by now that Trump tends to threaten a lot worse than he actually ends up imposing. And everybody seems to have gotten used to the idea that this is all part of some kind of negotiation. He wants something, so he goes and he threatens tariffs, and then we'll see if he gets anything he's after. One other thing, I'm just really intrigued that voters don't seem to care that much that Trump wants to basically raise the cost of goods they buy every day. I mean, that's what tariffs do. And there was some insight in this from new research from Morning Consult. They just did a poll asking people what they thought about tariffs. And I'll just put out one of these findings. I've written about this week. But the one finding that I thought was really interesting, they asked people, what do you think a tariff actually is? And they gave them four options. And only 25% of people correctly said that a tariff is a fee that an importer in the United States pays to import a product. 60% thought that either the foreign government or the foreign company importing the product pays a tariff, and 15% said they didn't know. So only 25% of Americans even know what a tariff is. So I guess maybe that explains why people don't seem to mind if Trump actually plans to do this. Now, if this actually raises people's costs, they will. But I think Trump is going to be pretty crafty and maybe make this happen in a way that people don't actually see.
So a few things there, Rick. I mean, the question about what does this mean for the average American consumer? There's a number of studies that have been out there. The Yale Budget Lab has one of the highest estimates. They talk about more than $7,000 for an average household if these tariffs do go through. And that's not even including Mexico and Canada. But one of the questions I had, you mentioned the market reaction a little more subdued. And that is yes, because I think all of us are having some flashback to 2016 to 2020 when we did constantly hear about these tariff threats. There is a USMCA in place, a free trade agreement between Mexico and Canada, which, by the way, was renegotiated as NAFTA 2.0 because of Donald Trump. What does it mean for that framework if, in fact, can he impose tariffs when there is a free trade agreement in place already between the U.S., Mexico, and Canada?
I mean, so I'll give a short answer and then let Ben. Ben, I hope you've brushed up on your trade expertise. You can explain all the details. So the short answer is Trump doesn't care if he can actually do it or not. I mean, one of the famous questions from Trump's first term is, can he actually do that? And the answer to that question is he can certainly try. So Trump tried to do a lot of things that it turns out, some of them he can do and some of them he can't do. So, I mean, Trump doesn't mind breaking things. He doesn't mind causing chaos. And what he can try to do is just impose these tariffs and then let it litigate. Let everybody make their claims. And I don't even know what the judicial mechanism is here anymore, because I mean, basically the World Trade Organization is out of it and was kind of somewhat toothless anyway. So what if Mexico or Canada disagree, but the United States says we don't care? I mean, maybe it just goes through anyway. Ben?
I think that's part of the answer there, is that essentially whether trade experts don't actually know, people that are much smarter than I on trade don't know if this is the end of USMCA if he goes through with this. I think the bottom line is it's sort of functionally the end of USMCA. If Trump goes through with this and Mexico does retaliatory tariffs, that pact is kind of on ice until it sunsets in 2026, and then it could be an opening to renegotiate. I also think, to kind of go back to your earlier point of why Canada is part of this, I think that's part of this here, is that sort of the USMCA is those three countries, and then by bringing Canada in, you kind of kickstart potentially those negotiations by grouping them all together. I think the other interesting aspect of this is that all three of these negotiations, I would think, will kind of operate on different platforms. I think China is clearly the hardest one. Mexico is also really hard. Maybe Canada, they can sort of figure out a thing. Trump can take a win there and then deal with these bigger, more challenging countries, in his view.
I read one analyst today or this week who said the report card for how Trump is doing as president is the stock market in Trump's mind. That is how Trump thinks of it. If stocks are going up, he doesn't really care what impact his policies, tariffs, or whatever. The other big one is deportation. If stocks are going up, Trump's going to say it doesn't matter. The country's in great shape. If stocks go down, if stocks basically say we don't like this, then that is what gets Trump's attention. So if you buy that way of thinking about it, then what's likely to happen with tariffs is he's going to play with different numbers, and he's going to see what the market reaction is. So there really is no market reaction on now when Trump has first said, well, here's what he plans to do on his first day in office, which is still almost 2 months away. But that'll change as we get closer. And back to 2018 when Trump was actually imposing tariffs. I mean, we had markets yo-yoing based on it's going to be 25% no, and now it's only going to be 7.5% or whatever. And markets, in the end, were kind of okay with it. There was a lot of volatility back then, but it was generally okay with markets. I think that's how Trump's going to play it again.
Strap in is what you're essentially saying, Rick, because we're going to see a lot of these play out publicly. Here's the other question. I mean, we kicked this off by saying that we now know who Trump's nominee is for Treasury Secretary. And this is a question to you, Ben. I mean, this sets up an interesting dynamic, right? You think about Scott Bessent and where he stands on tariffs. And then you've got Howard Lutnick, who's, now the nominee for Commerce, who's said publicly that he believes it can be used as a negotiating tool. How are we likely to see this play out internally if the president-elect has already put it out there saying, I want to move forward with these tariffs?
Yeah. I was working yesterday or earlier this week on a story about Bessent, and it was about the honeymoon period. It was on Monday, and then that honeymoon period ended really quickly when Trump did this. So I think Bessent is Trump's kind of firewall to a certain extent. He's the guy who's market friendly, who kind of makes markets gives this kind of muted reaction you're talking about here. They believe that that Trump can be moderated on tariffs, and Bessent's the guy to do it. The question is, to your question about it internally, when Trump is sitting at the table with Howard Lutnick, who I would argue kind of plays into Trump's instinct. Howard Lutnick talks about how the era of William McKinley was great, and it was great before we had income taxes. And you have Scott Bessent, who can kind of give a market reaction. Who wins that argument in Trump's mind? And that's the big question that we don't know yet. And we don't know who else is going to be around that table to kind of push Trump in one way or the other, whether it's towards his tariff instincts or towards a kind of more market-friendly direction.
Scott Bessent is basically a heavyweight. Markets trust him, apparently. I think a lot of us don't know that much about him or what he would actually do as Treasury Secretary, but he's seen as somebody who's of the markets. So that's why you saw market buy-in. So in an actual Trump administration, maybe this will be something of a force for stability, at least economically.
Yeah, if we can learn anything from the last administration or last Trump administration, it is that the Treasury Secretary was the steadier hand in an administration that had a lot of volatility, shall we say. We're going to take a quick break here. We'll be back with much more here on Capital Gains, including our guest, Garrett Watson. We'll be right back. Welcome back to Capital Gains. We are now joined by Garrett Watson. He is a senior policy analyst and modeling manager at the Tax Foundation. Garrett, welcome. Before we ask the first question, I kind of want to defer here to Ben as the setup guy, because Ben has taken on this task of going through all the list of promises we have heard from Donald Trump, at least on the campaign trail when it comes to taxes. Then take it away.
For sure, yeah. So, Garrett, I promise I won't make you repeat this whole list at the end, but I made a little pet project to kind of chronicle all of them, and there's an even dozen. So I'll read them really quick, and you can tell me which I can cross off forever and which I should pay attention to. So real quickly, all 12. Fully extending the 2017 tax cuts. No taxes on tips, overtime, or Social Security. Lowering the federal corporate tax rate. Eliminating the SALT cap. Tax credit for family caregivers. A car loan interest, making that deductible. Ending double taxation for Americans. A new first-time homebuyers credit, unspecified additional cuts for working class, and best for last is eliminating the income tax entirely in favor of tariffs. So take your list. What can we ignore entirely, and what should we actually be paying attention to from that?
So I think the central focus headed into next year for sure, and the top priority for Congress in particular, is going to be the looming expiration of the individual side of the 2017 tax law. It amounts to over $4 trillion of tax cuts over 10 years. In our estimation, over 60% of American households would see a tax hike relative to next year if it were to expire at the end of next year. And so that's going to be priority number one. Then the big question is, how do you fit in this raft of additional tax cuts that President-elect Trump is proposing that, of course, would add to the revenue cost? There's a few different tools to think about that, right? One is a lot of the design details of these new tax cuts weren't really fleshed out during the campaign. We haven't heard a lot of detail. That's actually an opportunity for both Trump and Congress to fiddle with the design to potentially limit the revenue cost. Maybe they make them temporary over a few years to test them out, so they can balance the desire to fulfill some of the president's promises on the tax side while also trying to make the numbers work, because that's going to be the big question for Republicans. Can they get a top-line deficit number that they can live with in both chambers that also fulfills a lot of these promises? So I think that's the big picture question. And of course, the other big thing, which y'all were just talking about, is the looming specter of tariffs. Does that come into the equation in terms of the revenue? Does that make the math work a little bit better? Does Congress actually get involved? That's another big question. To what extent will that be led primarily from the executive side versus Congress? All of these are open questions right now that I think both the transition team and Congress are trying to grapple with.
Garrett, I just want to grab on one of Ben's 12, no taxes on tips. So this is a bad idea. I'm happy to say that. Analysts don't like this tip. It was clearly a sop during the campaign by both candidates to voters in Las Vegas, where there are a lot of hospitality workers. Trump did end up winning Las Vegas. Maybe that helped. But first of all, this would only help people who get paid in tips, and most Americans don't get paid in tips. It would do nothing to help other lower income workers who don't get paid in tips. There's even this idea that higher income workers could suddenly start to say, "Oh, I'm going to declare half of my income as tips, and it's going to be untaxed." So this seems like a really bad idea, and yet you see members of Congress are now introducing legislation to actually make this happen. So, I mean, can you see Congress actually passing that one provision?
Given that there is some legislative language out there, that could be a starting point. I think there's some design detail to figure out, right? One is, how do you deal with avoidance opportunities, as you just mentioned? How do you deal with whether or not there's going to be a limitation on the amount of tipped income that's exempt, or if there's an income limit? Things like that to figure out. Whether or not the tips are exempt from payroll tax is yet another question. But I think, as you pointed to, right, one big theme with a lot of these tax cut proposals is it's not clear what the policy goal is. What exactly is the problem we're trying to address? And that's probably a better starting point than starting with very targeted tax cuts that yield themselves to avoidance opportunities and complexity and make the tax code even more of a bear than it already is for taxpayers, while also reducing revenue. So I think that's going to be a question mark there. One big, of course, uncertainty is how hard is the administration going to lean in on these additional tax cuts? I think this is my intuition, is a lot of policymakers want to focus on extending the 2017 tax law rather than prioritizing new tax cuts that make the math harder and are a distraction. But if Trump really leans in hard and wants to see some of these things added in, it's going to be hard for Congress to resist that. So they'll have to do the hard work of filling in some of the design details if they want to move forward. Another question is, to what extent do they try to make these new tax cuts temporary? That's another thing they could do, arguing that, hey, this is a test drive. Let's try this for a few years. If it doesn't work, we can always allow them to expire. That's another option in their toolkit.
Garrett, there's a lot of questions you put out there. I mean, my big question is really the deficit, right? And you said what is that number that Republicans can live with, top line? You've had the number coming out from the Committee for a Responsible Federal Budget, $4 to $5 trillion over the next 10 years is what they've put out. Is that a number that you think Republicans can stomach?
I think right now, as we're seeing, and this is very much generalizing, but there's a bit of a split between the chambers on this question. And that was actually an echo to, and a similar dynamic to 2017, where it appears the Senate may be a bit more interested in increasing the deficit than the House maybe. That's partly because they may view the extending current policy, that is the current tax cuts, as not being the same as creating new tax cuts. So it's a question of compared to what. So they may be more interested in a larger deficit increase in a reconciliation bill. The House may be a little more reticent on this question, especially given that they're going to have a very narrow majority, less than a 10-seat majority, compared to, I believe it was about 40-seat majority in 2017. So it only would take a handful of members who are really worried about the fiscal trajectory of this country to ask for it to be trimmed back. The big temptation and the best way they could deal with this logistically, not necessarily in terms of policy, is to extend things temporarily. So that $5 trillion number is accurate over 10 years, but that comes down quite a bit if you were to extend this to, say, 4 or 5 years. So that may be a temptation. That, of course, comes with a big trade-off, which is we got to do this whole exercise again in a handful of years, and it may not be under unified Republican control. And so that's going to be another question mark there. In our view, I mean, there isn't a lot of oxygen right now in completely redesigning or reopening all the decisions that were made in 2017. That's always another option to try to reconfigure things a bit, but that lends itself to a lot more work and always creates the risks that you might not get enough votes for whatever that looks like in both chambers, given the narrow majorities. So I think that's going to be the primary temptation moving in is something more temporary, depending on, of course, the offsets. I think that's the other big question, the tariffs being the biggest one. Others we've heard about, of course, as y'all may have seen, is potentially paring back some of the green energy credit expansions that were introduced in 2022 by Democrats in the Inflation Reduction Act. That could bring in upwards of potentially $800 or $900 billion. Just a partial offset, but that does make the math somewhat easier if they can get that on board.
So here's something that they may reconfigure from what they did in 2017. And this is not on Ben's list of the top 12. So let's make this maybe number 13. The SALT deduction, the state and local tax deduction, that was capped. And there seem to be enough Republicans who want to get rid of that cap that maybe that will actually happen. How do you see that playing out, Garrett? Is that a realistic possibility that the cap on that deduction goes away?
What we've seen on SALT the last few years is there's actually been somewhat of a bipartisan interest by a narrow handful of members, particularly in the House, who represent districts where SALT was a predominant concern. Think Republicans and Democrats representing a lot of districts in blue states on the coasts where SALT was very much binding for upper income households with high property tax bills and state income taxes. And so with this electoral result where you have a handful of Republicans representing the majority in the House, that means I think the pro-SALT caucus has some leverage here to ask for something. The missing piece has always been, is there a compromise position that the SALT caucus can live with, that the rest of the conference, many of whom are actually skeptical of SALT deductions, can also live with? One possibility that seems to be floated, including even by Speaker of the House Johnson recently, was we know the cap is expiring at the end of 2025. Maybe we extend it, but we make it more generous than it is currently. So there's a few options there. One example is currently the deduction is $10,000 regardless of your filing status. So you could double it for joint households, so there's not that marriage penalty, for example. You could make the whole deduction more generous and double it for joint filers. That would reduce the impact on a lot of households in these districts while not completely getting rid of the entire cap. And that would bring in some additional revenue to help offset these other tax cuts. So there's an equilibrium there, but it's always, of course, a big question whether or not that's a compromise everyone's willing to live with. And one, of course, big question was SALT was actually going to be potentially on the table as going even further and eliminating the entire deduction as a possible offset. Folks were talking about that as recently as this fall prior to the election, but I think given the electoral result, that option is likely off the table.
For sure. I'm with you, Garrett, that I was looking back at the tax cut, the 2017 vote, and there were 12 no votes on it by Republicans, almost all about taxes. And it's going to be a much smaller margin than that for sure. We're almost out of time, but one other thing that's really important for our audience is the federal corporate tax rate. Would love to get your thoughts there. One thing that's interesting to me about it is kind of Trump's journey on it. He first was kind of for taking it from 21% to 20. And he actually talked behind closed doors about how 15% might be too big of a lift. By the end of the campaign, he was standing in front of a banner that said 15%. Curious kind of what your sense of the impacts of different cuts would be there on the economy overall and sort of business activity.
So we found in our estimates at Tax Foundation that the corporate rate is one of the more damaging ways to raise revenue. And so getting us in a more competitive position, bring it down to 21% in 17 was the right move. And there's some opportunity potentially to trim it further if we want to be even more competitive. Of course, it's got to fit into the context of this revenue situation. And the other wild card or twist here is President-elect Trump has talked about providing that tax cut to 15% for corporations who invest domestically. And so that'd be a little bit of a design difference from the general corporate rate change in 2017. One ambiguity is whether or not that would work more like the old deduction for domestic activity that we used to have under the corporate rate, or if it would be only restricting that corporate rate cut for domestic corporations, and multinationals, for example, would get none of it. So that's something that would, of course, change the revenue costs and the incentives moving forward. I think the big question is, does that fit into the other priorities, including other pro-growth provisions like making bonus depreciation and expensing permanent as well and bringing that back, which has support on a bipartisan basis.
So put away the 15% banner? Is that what you're saying, Garrett?
I think there will still definitely be champions on that in Congress. I think Republicans do want to see that rate go up down. We're about average right now across the industrialized world. So that could be a possibility. It's just a matter of making that math work. The other thing is they may want to try to make that permanent if they did it. And that would require other offsets to get it through the Senate. So I wouldn't put it away quite yet.
Good.
Okay, all of this should make 2025 an interesting one, right? Garrett Watson, thank you so much for joining us today. That does it for Capital Gains here. Our thanks to Garrett, Ben, and Rick as well. And to you for joining. Make sure to like and subscribe to Capital Gains wherever you get your podcasts. We'll be right back here next week.
Welcome to Warrior Money, the show devoted to supporting our brother and sister veterans in the business world. I'm Patrick Murphy, here with Dan Coons. All right, Dan, let's talk about the headlines dealing with our veterans. First up, veteran homelessness. It's down 7%. It's the lowest level it's been. What are your thoughts?
I mean, anything that helps our brother and sister veterans find themselves in homes and find themselves in a warm home, that's really great for us. I think a lot of that has to do with the awareness campaigns that the VA was putting into making sure that people understood what resources were available, and also understanding, being really practical about the problems. We've got some friends, like veteran friends we know, like Dave Foster, who are out there at the business side trying to create solutions for veterans homelessness. So I think what we're seeing here is like the momentum that's been built through the PACT Act, the ability to tell people what's up, partnering with organizations, and then building that support was really what's critically driving.
Yeah,
this.
that's right. That whole, public-private partnership that Dave Foster and others are really getting after.
Yeah, I don't know how else you scale to solve the problem, because it can't just be a VA. It can't just be a VA thing, and it can't be just, hey, like, I can't believe you guys have homeless veterans. Like, there's no amount of money in the world that the government can spend to support that. So I think we've got to be really smart and judicious about, like, where do we get the most return on our investment? How do we support the folks that need it? How do we get to the underlying issues, whether it's substance abuse or lack of opportunity or lack of space, and how do we solve those issues as well, and then give people the ability to move forward?
That's right, and living by that ethos that we leave no one behind.
Yeah, it's the only ethos that matters.
Yeah. So, down 7%, lowest it's been, but no one's spiking in football because we got a lot more work to do.
That's right.
All right, next topic, we have VA telehealth. VA telehealth, people don't realize that the VA has literally invented things like telehealth, the nicotine patch. They've done phenomenal work in taking care of our brothers and sisters veterans for decades now. But telehealth, the headlines say they're going to get rid of copays with telehealth, and they're going to say we're going to access more telehealth to non-VA facilities. Thoughts?
What I hear is that the VA is the largest integrated healthcare system in the world. What I hear is that we've got a generation of veterans from World War II all the way through this most recent generation, the longest wars. And the way we support people has to be cost-effective, economical. It also has to be the way people receive care as it is now. You can't have commercial for-profit organizations doing it one way and then the VA completely not doing it the other way. So I think it's really about integrating and modernizing an enterprise that's gigantic to do it the right way now. You also have to put resources and awareness behind the need for it, and then also, as we've learned, like policy behind it to support good practices.
No doubt. I mean, we all know that mental health is just as important as your physical health, right? We PT, we get after it in the gym, but at the same time, you got to take time to go see a counselor once a quarter, right? Just to check in and have that relationship so when you need it.
Yeah, I think it's I think also that's like to your point, yes, and it can't just be based on urban environments, right? So we've got to give people access that live in rural communities that in their community health organizations are struggling to get access to care. Well, veterans also have that same access to care problem. So I think as we think about this, like, it's a whole of government's problem, it's a whole of society problem, and it's a community-based problem. So we just got to figure out better ways to do that. And then, of course, my brain's like, well, that's why we need broadband for everybody. That's why we need connectivity in these different places. And that becomes a private-public partnership problem as well. I'm just going to say PP from now on. But anyway, that's how this starts to work out for everybody and how we move this massive organization forward.
Yeah, you're talking about the broadband stuff with the broadband expansion.
Yeah.
Because there's a digital divide in our country and what more we need to do. And that's why it's important to take care of our brother and sister veterans using telehealth, because it's so effective.
Yep.
We're Army veterans, but like my father and grandfather, our next guest is a Navy veteran who has gone on to careers in both government and the private sector. He served as a senior aide to President Barack Obama, an advisor to the Biden-Harris campaign, and is now a partner at the lobbying firm Capital Counsel. Welcome, Rob Diamond.
Thanks, Patrick. Great to be with you today.
All right, brother. Bottom line up front, give us the bluff. Why are not more veterans involved in political public service?
Oh, it's a great question, and you're the perfect example of why we need more veterans in public service. You've been such a leader over this generation of folks stepping up and finding new ways to serve in government. I think it's twofold. I think one, running for office is intimidating. I think for anybody, let alone service members transitioning out of the military, where do you start? What office do you run for? How do you raise money? We see these sums of money that seem enormous to be able to fund a campaign today, even at local and state levels. But I think people also need to realize it's not just about elected office. There's so many opportunities to serve in government, in non-elected capacities, in city government, in state government, in the federal government, working for agencies that have a national security focus, have a veterans focus, have a real benefit to the community broadly. So I think it's just, there needs to be a more collective effort to recruit veterans into government, to recruit veterans running for office. I think we've seen a strong push and a strong support for those who are willing to step into the political arena and throw their hat in the ring. But we can always do more.
Yeah. I always tell people I was blessed to win at 33 and to win again. It was, changed my life. But, I did it because I lost 19 men in my unit in Iraq and to pay it forward. And I also tell young veterans, like, hey, there's 600,000 elected positions in America. You don't have to go for the top 535. So I think it's important. All right, but give me your why. Why did you join the Army? Why did you go to the Navy? I'm sorry, the Navy. Why did you go to Naval Academy to begin with? What led you that? Is it a family thing? Is it
no? I don't come from a military family, which is always sort of your first question you get. I'm the fourth of 5 kids. Grew up on Staten Island, New York. Mom was a nurse, and I just always had a sense of wanting to serve. I was looking at a number of places to go to college, and the academy just resonated with me. I won't lie, it was a job. You knew exactly what I was going to do when I was going to graduate and graduate into the Navy. And I don't regret a minute of it. It was a transformational experience for me. I can draw a direct line from making that decision, back as a junior in high school in 1994 to kind of where I am today, and those experiences along the way. Everything I learned there, everything I learned as a junior officer in the Navy, serving at sea, leading those sailors, has meant the world to me.
Yeah. What did you do when you were in the Navy?
I was a surface warfare officer, so I did most of my time stationed on a guided missile destroyer. The USS Bulkley, DDG-84, was lucky to be assigned to a brand new Navy ship at the time. I took it through its final shipbuilding phases down in Mississippi. Got to take it out for its first test trials and sea trials out there, and actually take it all the way through its first combat deployment on the way in the Middle East in 2004. So fascinating life cycle of a ship. Did my last 2 years in Washington, D.C., doing legislative affairs work, which I think gave me a little bit of the bug as to where I wound up today. Was an aide to the Navy's Chief of Legislative Affairs in the Pentagon, and then worked in the House of Representatives for a year.
Great. So what does a legislative liaison? You say? What is that? What do they do? And like at some point it goes from being like the Navy to the business of the Navy.
Yep.
And how do you fund things? How do you budget for things? Like, can you talk a little bit about that transition process you went through?
That's exactly right. I mean, that office is essentially the in-house lobbying arm of the Navy, and each service has one, and they work very closely with the committees in both the Senate and the House, the Armed Services Committees in both chambers of Congress, to shape those major pieces of legislation that happen on an annual basis, the National Defense Authorization Act and the Defense Appropriations Bills, which fund and authorize our military. And that's how we man, we train, we equip, and we fight because of what the Congress gives the military through those pieces of legislation.
Yeah, can you talk? What are those things to the people that aren't familiar with it, or from the people that aren't come out of our business community out there? Like, what is the NDAA? What are those different pieces of legislation?
Sure, they are the annual acts of Congress that basically provide all the funding. So the Defense Appropriations Act is one that's passed every year that actually funds the military, and that's buying the airplanes and buying the bullets and buying the food and paying for all that stuff. The authorization bill is what sets policy. It's really what allows the Congress to say, here's where we want the military to go. You can think of everything from the numbers of ships that the Navy will be authorized to have, to the amazing work that Patrick led to fight for our LGBT brothers and sisters to be allowed to serve openly in the military. And that was all done through the NDAA.
Yeah, you were part of the appropriations process when you were in the House.
Yeah, I was lucky. I was an authorizer on the Armed Services Committee and then an appropriator on the Appropriations Committee. So, when you look at even the Navy or the Department of Defense overall, it's over $800 billion a year budget. It's the largest federal agency that there is. And I will tell you that the Navy does a heck of a job. And the Army might be bigger than the Navy, but they get more funding than the Army. So hats off to you, Robin, and your team.
Yeah. So it's pretty clear to me to kind of see how the transition from your last couple of years led you into the next thing you did. But can you talk a little bit about your transition from your Navy service into what you did next, and then what you did for your career?
Yeah, so I did about 7 years active duty. I got out of the Navy in 2006, came back to New York here where I'm from, got married, started a family, was working in finance, which I guess is what you're supposed to do when you move back to New York.
Yeah.
But in the back of my head the whole time was a deep concern of what was happening in the veteran community, which I know you guys have shared over the last decade and a half. You look back to those years in 2006, 2008, when Patrick ran. For the first time, we were dealing with near double-digit veteran unemployment, 22 suicides a day, hundreds of thousands of claims backlog at the VA. I mean, the issues were just overwhelming. And I just had this sense after I left the military that if I didn't care about those issues, who was going to care about those issues? I had just spent 11 years of my life in uniform. And if I wasn't going to figure out a way to fight for them and help fix these problems, then nobody was. And so I came to government and I came to politics through a lens of caring about veterans issues. It's what got me active. What's got me motivated. And what brought me into first the 2008 presidential cycle. Got to work on the team that helped elect Barack Obama. Got to work on both of those cycles. Got to and then go to the White House and continue to work on those. And now I do that on the private sector side, where I continue to lobby for these issues that affect our service members and a lot of issues. I work on clean energy. I work on finance issues. I work on transportation. I do a lot with cities and states accessing infrastructure dollars. So it's been a really great way to, again, leverage a lifetime of work both in the government and out of the government to really move policy forward.
Yeah, that's awesome. Well, listen, we're going to pause it right there. We're going to be right back with more from Rob Diamond. So stay with us. Welcome back to Warrior Money. We're talking to Rob Diamond, partner at Capital Counsel. Rob, you talked about that transition going back from your time active in the Navy to get involved in political public service. What was it like to work in the Barack Obama White House?
It was tremendous. It was certainly the honor of a lifetime. It was something I never expected I would ever get the chance to do. It wasn't something I sought out. I got lucky, and one day the phone rang, and I got asked to come interview for a job there, and was lucky enough to get it. And it was a tremendous couple of years there. My only regret is that we constitutionally ran out of time. But it hits you every day walking into that building, the scale of the work you're doing, the decisions that are made there affect the lives of millions of people, not just here in the country, but across the globe. Every meeting you have is somebody's make or break discussion about what they're trying to achieve, or an issue they're trying to solve, or a problem they're trying to fix. And I took that deadly seriously. I really felt the burden, if you will, to be there every day, show up for work every day, be present every day. One, I knew the clock was running down. It's true in every administration, and that you wouldn't be there forever, and you just had to get as much done and as much good as you could do in the time you had.
Yeah, I mean, I look back to his time as commander-in-chief, obviously tripling the forces in Afghanistan and spoke up a lot on bringing him to justice. We had Admiral McRaven on, talking about that mission. You look at, as you mentioned, there was 16% unemployment of our post-9/11 veterans, passing the post-9/11 GI Bill. Right now, there's about 800,000 young Americans using the GI Bill, and unemployment's down to less than 3%, so that's positive. And as you mentioned, the repeal of Don't Ask, Don't Tell, he said it, Barack Obama in his first State of the Union, saying, we are going to repeal Don't Ask, Don't Tell because we kicked out 13,000 troops. What was that like from your perspective?
Well, I tell you, there is probably no better example of a successful public-private partnership model than what was built to take veteran unemployment down from 16% to now where it's right around 3%, essentially where it should be. It was an incredible effort to watch both the government and I give full credit to First Lady Michelle Obama and then Second Lady Jill Biden, who launched the Joining Forces Initiative, which was laser focused on trying to solve that and bringing the private sector in and solving those issues of how do you translate military service into private sector employment. That was a huge hurdle to overcome, and it was done collectively. It was done on a national scale, and it really should serve as a model that these big public sector problems are not unsolvable. They can be solved, and that's a perfect example of how government, and it took years, but it took sustained effort, but it was fixed.
Yeah, I was just at the chamber last week. And the U.S. Chamber they have the Hiring Heroes Foundation where they're partnering with corporate America. And it's great on the veteran side, on the 200,000 who transition every year. But with military spouses right now, I mean, when most American families are dual income families, we actually still have 21% unemployment with military spouses.
Yeah, and I mean, we know this as well as anybody. I mean, that is a uniquely challenging role to be a military spouse, that you will be uprooted dozens of times. My Naval Academy roommate just retired after 25 years of service as a Navy 06, leading the Navy Air Training Wing down in Corpus Christi, Texas. And I think he and his family moved 13 times.
Wow.
And how do you hold down a career? I mean, and in that environment. But what are the tools you can provide to help solve for that? The portability issues, the licensing issues. We know what they are, and how you build that support network, state by state, base by base, is critical in solving that problem. And we are not there yet.
You talked a lot about, you've referenced or talked specifically about scale quite a bit, and the challenge of scale. And we don't always appreciate how large and what the federal government does, specifically when you think about the partners that the federal government brings into it. You've been working on the infrastructure bill and the Inflation Reduction Act. Yeah. Can you talk a little bit more about what are they?
Sure.
And what have you been focused on in that work?
Yeah. So going back to the beginning of the
where are they from? Sorry.
Yeah. The early in the Biden administration, two landmark pieces of legislation were passed. The first one being the bipartisan infrastructure law, nearly $1 trillion piece of legislation, a landmark piece of legislation This country's talked about investing in infrastructure for a very long time. And that bill, again, on a bipartisan basis, finally did it. And it put hundreds of millions of dollars at work in terms of fixing roads and bridges and upgrading airports and expanding broadband across the country, modernizing our electric grid, providing access to clean drinking water pipes. I mean, you name just the foundational stuff that we have just neglected that are going to be, I think, strong drivers for our economy moving forward. The second piece was the Inflation Reduction Act passed shortly after that. Again, a landmark piece of legislation, not just for its size. Again, nearly $1 trillion effort, and it was the largest single climate change-focused legislation that the country's ever seen. So this is really trying to put the thumb on the scale of industrial policy here in the country to move us onto a clean energy economy, dramatically expanding wind and hydrogen and solar, battery storage, again, upgrades to our electrical system. We're seeing all this amazing technology come online with artificial intelligence and things like that, but that's causing huge demands on our energy sector, and we've got to continue to make this transition to a green and clean economy. And it's also an enormous economic opportunity for folks to find jobs. I think it's an enormous area where veterans should be very focused in looking to get into the clean energy economy.
You just essentially talked about $2 trillion worth of money, and that's unfathomable for a lot of people to understand how big $2 trillion is. How do you in your role shape or even think about that sort of money, that sort of influence? And mostly for our audience too, like if you're in business or you're in finance, how do you best approach that enormity of that problem? How do you think about that?
Yeah, so we're a client-facing business, so we advise different clients, and again, I work with mayors, I work with governors, I work with CEOs of companies, and they all have priorities that they're trying to meet through these funding opportunities. You can think about, I work with a city in Florida that has huge exposure to hurricanes, and they are always looking to figure out better ways to make the city more resilient, make the city more hurricane proof, harden it, and that's all infrastructure. So where were there programs where they could access dollars from the federal government to support expensive, large-scale construction to provide resiliency? Work with a number of clean energy companies who are trying to modernize their electrical transmission grid. This is all about keeping the lights on.
Yeah,
and we've seen these storms, whether they're ice storms in Texas or flooding and hurricanes in North Carolina, do devastating damage to electrical grids and the reliability. And that's something we depend on every single day. And we've got, this was a piece of legislation that provided both companies and governments access to funding on a scale we've never seen before to really start to modernize that equipment.
Yeah, I think we're looking at the infrastructure and why have to invest in it now because, even data centers, there's over 5,000 data centers in America. They're going to grow about a rate of 9% the next couple of years because of just the demand, and they're very energy. They consume a ton of energy.
And at the end of the day, it's just about economic competitiveness. I mean, you travel around the world. I mean, just take airports, for example. I mean, President Biden famously called LaGuardia Airport here in New York a third world, airport, I believe was the phrase. And my old boss, Governor Cuomo, and through a lot of federal support as well, have now rebuilt that into a world-class airport. You can travel around the country and see these upgrades happening. Because you travel around the world and you see these upgrades happening. I mean, this is all about long-term economic viability, long-term economic growth, and the health of our economy.
Now we're going to go to the Warrior Q&A.
All right.
So this is fast and furious. If you don't mind, Dan's going to lead it off.
Yeah, Warrior Q&A.
Market speed.
Yeah, who's a warrior that inspires you in your life?
Oh, who's a warrior that inspires my life? Oh, that goes right to my mom. So, raised 5 kids, give her all the credit for everything.
That's awesome. She was a nurse. I think you said, right?
Yeah.
Awesome. What habits help you achieve your success?
I think those same ones that were drilled in plebe year, attention to detail, showing up on time, getting the job done, not being afraid to say, I don't know, but I'll find out, sir.
What's some money advice that you wish you'd been told earlier in life?
Oh man, the time value of money in terms of investing is the single most, I think, underappreciated and misunderstood concept in finance. I mean, the fact that every day that passes that you're not putting a dollar away, you lose the magic of compound interest. And so, those young service members out there who are 18, 19, 20, young junior officers coming out of college, find a way to max out those savings accounts, those retirement accounts early, because that magic of compound interest is what, if you lose that time, you never get it back, and you are leaving, literally millions on the table if you get started early enough.
Yeah. Final question. So what skills and traits did you hone in military that's serving you exceptionally well right now?
I think it was really just to not be afraid to run at the problem.
Yeah.
I think we all
no matter how big it is.
Know how big it is, exactly. And just say, okay, like, it's my job to run at the fire. I think we learned that from day one as a junior officer. Your job's not to run away. Your job is to run at it and figure out a solution. And not everything's a firefight. It's not everything's life and death, but problems still need to be solved, and people need to lead. And so I think that. The military imbued me with that ability to always be, I think, the person looking to run at the problem and try to fix it.
That's your answer.
Hey, Rob Diamond, thanks for joining us on Warrior Money.
Having me.
We appreciate you, brother. All right, so listen, that's going to be our show. So please listen, subscribe, and review Warrior Money on Apple Podcasts, Spotify, or anywhere else you get your podcast. Or find us on Yahoo Finance. I'm Patrick Murphy. For Dan Coons, we'll see you next week.